Are they going to have to do the same thing to move some of their electric vehicles?
Okay, so let's imagine I want to go and buy a GM today. General Motors, whatever car it might be, some kind of EV vehicle, I don't know the brands, whatever. Let's say I'm going to make that call today. Why on earth would I do that today? Why on earth would I make that decision?
Because maybe GM is going to do what Ford does, which evidently, as Tom said, he broke the news to us that Ford said to them, we're going to cut prices, and if you bought recently, we'll pay you.
Am I going to take that risk, though? Am I going to take that risk?
It's a good point. Are we creating a downward spiral with price pressure by consumers when they start to see that there is some sort of willingness to cut prices after so many years of price hikes?
Can I ask a dumb question? Isn't there a huge demand for these vehicles?
Oh, massive, yeah.
So they're cutting price even though or is there a dog EV vehicle they're trying to get rid of?
I was actually researching this last night, and
Stuart, why did we not know that? You and I are going.
Hold on a second. No, this is interesting. The margins are so much fatter for the likes of Tesla than the likes of Ford and GM. They've got something like a 25% margin. So at what point do they just get greedy? At what point do they want to compete, particularly with Chinese EV makers and corner markets that are nascent and possibly have a lot of potential to grow?
We'll see if we get those cuts. We're catching up with the CFO a little bit later this morning. Exxon out with results as well for the fourth quarter, adjusted EPS 340. The estimate, Tom, 330. So we were looking for 330. We got 340. And the numbers from Big Oil over the last 12 months, Tom, pretty incredible.
Yeah, we're going to look at that too. We'll dive into Big Oil and the rest of it here, particularly off what we saw from Chevron. We take great pride, folks, in bringing you earnings away from the top 4 or 5 companies. We'll do that. At least are really on top of what industrials are doing. This is an important interview for Global Wall Street, arguably our most important interview of the day, because A, he nailed it last time he was on about the lift here, a sense of optimism from Stuart Kaiser with Citigroup, head of U.S. equity trading, but far more than that, head of a derivative thought. What's the bet right now? In all the literature, Stuart Kaiser, it's okay. Kaiser was right, 6%, 7% bounce, up we go, but it's just short covering where people go, oops, I got it wrong. It springs up, but there's no oomph to break out. What say you about the idea of there is oomph to break out and move higher?
Good morning, Tom. And way too much credit, but thank you. Look, I think the year so far, if I had to describe it, would just be events that didn't play out, essentially, right? Like, you came into the year with very low expectations across the board from both macro results as well as single stock earnings, and frankly, that data just hasn't been negative enough to justify the low positioning we had coming into the year. So how do you keep moving higher? I think you get a continuation on Thursday in particular of large cap tech earnings coming through, and the Fed is hawkish, but they're sort of reiterating a message that the market's already kind of gotten comfortable with. And on Friday, we don't get an average hourly earnings number that scares us. And if those things happen, then I think the market could continue to move higher. But I still think you need to approach this very tactically, kind of like a month-by-month basis. This is not a, hey, I can be long for the next 3 to 6 months.
Filter in Citigroup's securities analysts who talk to you all the time about their revenue dynamic. If we get the disinflation that Citigroup and others are talking about, what does it do to the revenue line?
Yeah, I mean, look, that's the issue. I think that's been a big challenge for the bear case that earnings were going to get revised aggressively lower, is that you had positive revenue growth that kept earnings a little bit higher than expected. Obviously, if revenues start to ease, then we're really focused, as Lisa mentioned, on the margin story. And, so that's where the debate will kind of center, right? It won't be on top line EPS. It'll be on the quality of that EPS and whether investors are willing to pay a premium for quote unquote lower quality earnings. So it is an issue, but frankly, I think that's an issue we'd like to have, relative to where expectations have been.
We talk about recession as if it's an event, it's a process. And in that process, you start to get companies defending margins. And we've started to see that really at some of these big tech firms. Is that bullish enough for you, for some of these names, to have a durable tailwind through the rest of this year, to see them defending margins, to see them cutting costs in the way they are?
I think it is, and I think investors have kind of rewarded that to some extent. I think people are willing to look through a quarter or two of pressure. If a company can give them guidance that 2 to 4 quarters out, the margins are going to kind of normalize a little bit. And look, all this, again, I think is expectations driven. You had such low expectations for earnings and such a bearish view on where they could get to. I think even, by hook or by crook, if a company can produce the earnings, people are going to generally respond positive to it, at least tactically. I think, now that we're back above 4,000 on the S&P, the questions get a little bit harder, related to that. But yeah, I think if If companies can show that they're making these cost cuts and that it's going to have a visibility into where margins are going to get over the next couple of quarters, I think investors will respond positively to that.
The earnings haven't been great. People say that the resilience has been pretty widespread, better than expected kinds of results. They haven't been. They've been worse than expected at a higher pace than at any time going back to 2014, with the exception of March of 2020, those 3 months. So at what point do we look at the earnings and start to see maybe big tech is reckoning with some of the margin pressure, but the rest of the universe is facing it in a much more significant way that hasn't been fully priced in?
Look, I mean, all I would go back to, I guess, is price action on that. Coming into the week, we had about 250 large cap stocks we'd been tracking. 99 of those fell on earnings, 150 rose on earnings. So even though the earnings haven't been coming in great, the price action, I think, is telling you that expectations were washed out enough where it didn't take much. I think, sometimes if a company cuts numbers down to where the buy side is, that stock is then quote unquote clean, and people can kind of own it. So yeah, I think expectations, again, I hate to keep using that word, but I think that has a lot to do with it.
Do you think that there's a clean read on tech because of how much bad news there has been priced in, but on the rest of the industrial complex, it isn't so clean, with a lot of disappointments leading to some pretty big price action?
Yeah, look, I mean, stock by stock, we could, we could certainly find some.
Tech in some ways poised to do better because of how much pain was priced in and how much of a house cleaning there's been.
That's our view, frankly, is that early last year it was a valuation story on tech, right? The stocks were very expensive, rates and inflation were higher, and you got that huge valuation headwind. Third quarter earnings were a little bit different, where companies started to talk about cost cuts, pressure on earnings, things of that nature, and that's when I think expectations started to really ratchet lower for the tech space. Our view coming into this quarter was not necessarily that the results were going to be all that great. It's just that expectations were so low that it just put risk reward to the upside. Expectations were low, positioning were low. So in that sort of combination, it doesn't take a whole lot to get the stocks moving higher. So again, this could be a quote unquote low quality rally, which we think it's been. If you look at what's driven the rally, it hasn't been the best and the brightest. But we do think relative to expectations, that's where we sat. Again, I think you have to reevaluate that now that you enter February, because you're on a 4,000 handle after a rally. That's different than being at 38, 38.50 coming into the year, I think.
We talk about this rally as if it's only been going on for a month. For the likes of Caterpillar, it's been going on since the end of September. That stock is up by more than 60% since then. They've just delivered earnings. Wow. The first earnings miss since the pandemic back in 2020. I keep hearing everyone talk about how do I want to play the China reopening story, and I keep going back to this. Well, it's been playing out for 3 months in the miners, in Caterpillar. Abroad, you've seen that. You've seen that story. In fact, for the banks over in Europe, it's been playing out since the summer. They have absolutely ripped. When you hear people say things like, how do I play the China reopening story? What are you telling them?
Well, I think you're right. It's gone in stages. I think at the beginning, a lot of people were using options to just get high payout, owning, let's say, the Chinese index, right? Then it became what you're describing as more of that infrastructure play. I think right now the question is how much of a consumer spending impulse can we get out of China as you fully reopen? And I think that started to focus people on things like, luxury brands, in Europe. I think, German equities have really benefited from this as well because they have a lot of export exposure. So there's still a group of the investment community, I think, that isn't really comfortable owning China equity directly and outright, just given some of the policy challenges. So what people are looking for is what is that second order trade? And I think it was metals and mining and things like that. And then it evolved into just like a consumer spending or tourism story.
Jim Umpleby over at Caterpillar he minces no words. In the near 100-year history of Caterpillar, last year was one of their best years ever. We have on radio and TV people stratified by this eco-Fed debate, all the uncertainties, and they're not in the market. How do they participate in Stuart Kaiser's optimism so they can possibly enjoy Caterpillar's near best year in 100 years?
Look, I think from an owning stocks perspective outright, as you know, we've been focused on more of these high quality stocks that you can kind of own through a recession. So that's, high quality stocks that are buying back a lot of their shares, don't have as much, downside earnings risk. So we've been sort of pointing people in that direction. And I think we're still of that view, Tom. It's most investors that I've spoken to, even though the market's rallied, they haven't really changed their baseline core positioning or portfolio, which still remains pretty defensive. So what they've been doing in this rally is using ETFs or options to just kind of add to their exposure around the edges. But I think when you sit down with them, they're not saying, oh, wow, we rallied for a month, my whole view has changed. It's more, yeah, I'm still conservative. I still want to sit in this portfolio. What I need to do is kind of risk manage around it. So I still think you're in this larger cap, higher quality share buyback, type story, and then you're just trying to adjust risk around the edges. And we haven't touched on it. You also have a lot of folks that are saying, "Why do I need to be in equities? I can be in credit, or I can be in bonds."
Fixed income more broadly,
which is the second thing, yeah.
Wasn't it easier a month ago? Everyone just came on a show and said, "Sit out the front half. It's going to be ugly."
Yeah,
then we'll get this second half recovery.
Yeah, now it's...
In June, there's this line in the sand.
Yeah.
Then everything just starts rallying.
Yeah, and now you missed it, sorry. It's over.
Well,
it already
that
happened.
could be, actually.
It ripped.
Hey, Stu, it's good to see you. Thank you, sir.
Thank you
Stuart Kaiser at Citigroup. Got into a big week ahead. I think I've said that for the 50th time already in the last 24 hours. The Federal Reserve coming up on Wednesday, so we'll have special coverage for you on Bloomberg Surveillance tomorrow afternoon. Then on to payrolls Friday, and in between, Tom, we are. And in between, we get some earnings and some data too.
Yeah, the earnings and the data are important, and somebody had a wonderful tweet out. The S&P 500 is at XPE. In the S&P 494, you take out 6
Oh, that was
companies.
Alf. I think that, yeah.
Yeah,
I think
it was a
Alf on
brilliant
Twitter,
tweet
yeah.
to just show the courage someone like Kaiser has to be in the market is when you take out those companies. Many people would suggest it's fairly
I can't
cheap.
verify the numbers, but the theme is kind of nailed on, right? You take out the big players with the
well,
big
they're
PEs.
trading 17 times earning, Caterpillar, and they got to be a huge China play.
CAT right now down about 1.8%. Futures negative 0.4%. On China, Leland Miller, the co-founder and CEO of the China-based Book International. That's coming up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The White House will end a pair of COVID emergency declarations on May 11th. That will mean the end of the controversial Title 42, a policy that's expanded expulsion powers at the border of the U.S. and Mexico. The emergency declaration also allowed millions of Americans special access to Medicaid, the program that provides health care to low-income people. In China, manufacturing and services expanded for the first time in 4 months. The country's reopening from COVID-0 and the Lunar New Year holiday spurred travel and spending. It's welcome news for the global economy, which is cooling and will rely on China's recovery to offset other risks. A new report says that Brexit is costing the British economy $124 billion a year. On the third anniversary of the split, an analysis by Bloomberg Economics says the effects span everything from business investment to the ability of companies to hire workers. The report estimates the UK economy is 4% smaller than it might have been. United Parcel Service forecasts sales below Wall Street estimates. The package courier is struggling with a drop in volume as shoppers return to stores. Meanwhile, inflation is cutting into spending habits. And Boeing will deliver its final 747 today. A cargo version of the jumbo jet will be turned over to Atlas Air. More than 1,500 747s were built over 5 decades. The plane could carry more than 500 passengers, and in Boeing words, it shrank the world and democratized air travel. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
Yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority. inflation strikes. Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
If we're sitting here in 3-4 months and the U.S. Corporate sector hasn't broken, if the benefits of lower inflation is helping consumers, then the China reopening, which we think is largely going to be a demand impulse, is going to have an impact on commodity prices, it's going to have an impact on goods prices globally, and it's going to add a reflationary impulse to the U.S. as well as the global economy.
And that right there is the big risk from Bruce Kasman there, the chief economist at JP Morgan. Great to catch up with him in the last 24 hours or so. From New York City, equity futures look like this on the S&P. We are negative 0.4%. Equities just a little softer, lighter, lower over the last couple of days going into the Fed decision tomorrow. Payrolls on Friday, tons of earnings in between. Yields basically unchanged, Tom, 353.27.
Oh, it's going to be interesting to see all of that debate, and what it comes down to is a recovering global economy. You know, we're going to talk about China here, but John, I would go back to France, which is doom and gloom, war, things are terrible, and they gave us a positive statistic.
Over the last 3 months, yes. Can that continue? Do we have to relive the worries about next winter? Never mind this winter.
Yeah, we'll have to see. Right
That's
now,
the spirit.
Yeah, it's very Bramo. It's Edge of Bramo. Right now, we're going to look at China. This is an important conversation. Leland Miller, are you guys done? Thank you. Leland Miller, co-founder and CEO of China Beige Book, with us right now, and truly excellent on the microdata of China. Leland, I'm confused. I've got Bloomberg Economics and a fabulous article out today. Really must read. I'll get it out on Twitter. Endicura and Shengshu, Bjorn Van Roy, who was just on the program. I butchered his name on the program as well, and Tom Orlick. And they're saying, forget about it. We're looking at 3-ish up to 5-ish GDP in China, and yet institutions have a much more cautious view on this, noodling around 3%. Who's right?
Well, I think this is one of the stories that's going to have to play out during the year. The China recovery is set up to be a very nice cyclical bounce back, but this could be a cyclical bounce back of a quarter or two, or it could be longer, depending on, one, whether consumers jump in, which is a huge if, and second huge if is if there's more policy support than, or I guess the policy support that people think. There's this assumption that the government is going to jump in and start stimulating on top of what's already an organic recovery. We're quite skeptical of that, but we're watching the indicators and trying to see where the government's head is on this.
My experience, Leland, is it always centers around a bailout of real estate. Let's call it healing real estate. Are they going to heal real estate with cash infusions from Beijing?
They're not going to heal real estate, but what they have been doing is culling the herd, and now they are going to ventilate the sector. So basically what they've been trying to do is take out the weak firms without killing the healthy firms, diminish property as a growth driver for China going forward. They've been doing that, but now you've got the potential for contagion because the numbers have been so unbelievably bad. Our December data, our Q4 data, some of the worst property results we've ever seen. So they're stepping in, they're providing credit lines, they're lowering mortgage rates. They want to make sure they give a little bit of oomph to the sector, but this is very different from the game changer it's being made out to be across the street. You got to be very cautious on what this actually means.
Where is the money actually going? Where are consumers spending? Is it all domestic? Are more people getting on planes? Are you seeing those flows go into commodities to travel around, or is it going into staples and just activities in the region?
Well, it's too early to see the trends for the entire year because you had this first month skewed by COVID and skewed by the Lunar New Year holiday. This month, all the pops in the data were around where you'd expect, which is travel, restaurants, hospitality. People were traveling again. People were moving around again. And so you saw a big pop in that data. Going forward, the question is, are consumers going to come back? There's this assumption that Chinese consumers are going to revenge spend. Yeah, they probably will a little bit, but the idea they're they're going to go do this and drive a recovery for the entire year. We've never seen anything like that. So again, we're going to watch the data because this is not the type of thesis we've ever seen play out before.
Where's the data? What's it pointing toward in terms of fossil fuel combustion, the idea of crude and natural gas, and what's going on with the coal imports from Australia? Some of these stockpiles, how depleted are they? How much is China going to have to import going forward?
Well, 2022 was awful. So there's going to be a lot of things going on, particularly early in 2023, which are going to lead to greater commodities demand. A lot of it has to do with how much policy support continues on through the year. Are we going to see them double down into some infrastructure and some other things? Because look, if you're talking about the consumer driving, the recovery this year, which again, we're quite skeptical of, but if you are, then you're not leading to huge tons of oil demand skyrocketing. You'll see it from jet fuel if there's more travel, but people are mixing their investment theses here because they're so bullish on the China recovery. But that doesn't necessarily mean there's going to be a jump in oil demand throughout the year. So we have to be a little bit cautious on that.
I'll make a joke of it, Leland, because that's what we do on a Tuesday before Fed Day. But the joke is, does China do work from home? But really what it comes down to, are they back to work? I mean, with the advent of COVID, are people back to work in those manufacturing plants and all of the ancillary businesses to it? Are they back to work, and are they taking home a paycheck?
They're not back to work yet because, the COVID situation still hasn't calmed down. Maybe March they're back to work. Right now they're traveling for they're either sick or they're traveling for Lunar New Year. So manufacturing hasn't, looked better. But we got to keep in mind, from a year ago level, it's way down. You can't see it when you look at the PMI because the PMI can't track data from year to year. But things have been up from the end of last year, but they're down on year. They're down from 2 years ago. So manufacturing is not seeing this superstar recovery just because the PMI had an upside surprise. Understand that manufacturing is not going to drive growth this year with a global economic recession potentially looming. It just happens to be one good month in the data.
Leland, how much are you watching what's happening in Washington and the sudden reprising of some of the animosity that U.S. politicians have toward China and the potential ban of exporting supplies to Huawei? How much is that factoring into your outlook for China for 2023?
Well, it's never gone away. I think people make too much of these meetings when Xi and Biden, shake hands, and Tony Blinken and Janet Yellen are going over to China, and a lot of people read into this saying, "Oh, the relationship must be getting much better." Well, it's good that tensions are calmed down in a short term, in a short period, during a short window. But this does not mean we're not heading in one direction in terms of tighter export controls and more tense policy back and forth. So this really hasn't changed our outlook at all. I think people have to understand that the relationship is going to get more fraught over time, not less fraught. And this is just another headwind for the economies of both countries.
Leland, we've got a lot to talk about for the year ahead, that's for sure. Leland Miller of the China Beige Book. The latest data out of Taiwan, the export orders for 2022. Lisa, that data was pretty ugly, to be fair.
Well, to be fair, a lot of it's because of the semiconductor cycle that we've seen and how you see that pretty widespread from all of the semiconductor manufacturers. They just have a glut of chips. That said, China needs the reliance on Taiwan. They need those chips. Everyone needs those chips in terms of some sort of national security reasons. So, again, how much is this a momentary cyclical blip versus something more substantial?
The year ahead is really difficult to call. The next 2 months is really difficult to call. You've got Neil Dutta of Renmac on the one side saying the Fed story only works if the economy is slowing down. Sorry, but I don't see it. On the other side, Steve Englander of Standard Chartered. And Tom, these are really bright people with completely different views on where the Fed is going to be come March, never mind year end. Steve Englander talking about a pause at the March meeting.
That's the smartest summation I've heard in ages, John. It was dead on about the divide that's out there. And to me, where I go is sitting in the chair next to me are repeated people who are saying the path is down to under 4% inflation, dare I say under 3% inflation. No one has a framework right now of what 2.8 or 3.2% inflation means to our markets, to our lives, to our future, performance here across nations. I mean, forgetting about the war in Ukraine. I mean, no one's ready for that massive stochastic move lower in inflation.
Lisa and I talked about this yesterday. I think probably the most important line in the last couple of months was Sarah House of Wells Fargo when she talked about the final mile from 4% down to what? And do we get stuck there or not?
Well, it's just a set of different opinions wrapped around Dutta Englander maybe as polarities, but you know, it comes down to whichever inflation number you want to look at. Does it come down, as Liz Ann Saunders says, with housing being the dominant mystery for the American people? And it appears away from what we're living in New York. The three of us are completely biased, is the fact is rents are coming in.
And does China confuse things all over again? Tom, can you really make a call on the global economy in the next 12 months with a deep understanding of what China's reopening means for the inflation backdrop? I've got no idea.
Bloomberg Economics with Tom Orlik and all of his leadership, they're at 5% plus. And you got other people modeling out, no, 3%, as Leland says, they do better and then they pull back. I don't know.
Futures right now, down a third of 1%.
I think we need to research it.
On the S&P. You want to do some research now?
Yeah, when Hong Kong opens up, we need to go shake hand to currency.
Of course, Lisa.
Come on.
You're ahead of me on that.
Obviously.
Of course. It's just another trip. It's another trip that we won't be doing.
Yeah.
On a 10-year, 353.46 from New York. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, you know, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
The moment news breaks, no one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority. As growth forecasts are increasing and inflation is falling, will the European Central Bank make its fifth rate hike in a row? How high do rates need to go? Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
The central banks, and certainly the ECB is pushing this line, have got much more wood to chop. They've got much further to go.
Coverage begins Thursday, only on Bloomberg, your global business authority.
Opportunities for this rally to go longer and higher than you would expect.
It's not a strong growth picture, it's a grind, but I think it stays positive.
We're not as comfortable as I think the market is that the Fed is done here, that they will get inflation under control, that we will have a recession.
If we are going to see a recession sometime this year, I don't think that's priced into the S&P at all.
If the data continues to moderate and inflation continues to fall, that's your hike and pause in March scenario.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What time do Fed officials get out of bed, TK, down in Washington?
Well, it's 8:30. Al Hunt always told me the wonderful.
You're going to troll them now?
No,
Day
just
starts
asking.
at
They're not
8:30.
listening.
You know, get the kids
They're not
off to
awake.
school.
No, the vice chair tunes in at about 45 minutes. I know that. So you get to say whatever you want.
Until then.
Until 7:45
And then it doesn't
Eastern
happen.
time.
Yeah.
Live from New York City this morning. Good morning for our audience worldwide. The two-day Fed meeting begins, I assume, in the next couple of hours when they all get out of bed and get ready, Tom. Chairman Powell tomorrow in that news conference, TK on to payrolls on Friday, and then a ton of earnings this morning and going for the next couple of days.
Yeah, the summary of it here is margin dynamics. Margin dynamics for Apple and the rest, Amazon and their recovery story out of the pandemic, but also to watch wage dynamics out of the jobs report. And of course, this ECI report is important as well because that includes benefits.
And the data abroad as well. The Chinese data out a little bit earlier this morning. Lisa, upside surprise, reopening, the data rebounds, all the kind of stuff we expect, and the IMF playing catch up.
So what's priced in? That we have to keep asking that question. What has been priced in? You pointed out very smartly that we've seen this over the past 3 months. We've seen a rally kind of really gain steam in certain areas tied to the reopening trade. So have we priced in more momentum than there actually is? How do we even evaluate that? And to Tom, your point, what is the end Fed funds rate that we're talking about? What is the new normal when it comes to inflation to start expecting where we set these valuations? To me, that is really the key question.
Yeah, they're saying 5, and Tom, we've got people lining up to say maybe this hike tomorrow might be the last one.
You know, there's a set of opinions, and I'm sorry, it's data, and critically, it's data ex post. They have to wait to see. And in a fully employed America, and looking at McDonald's horrific numbers coming out right now, it's McDonald's is trading 3% under a record high. Okay, 3% up, and they hit a record high. They've done 12.7% over the last 10 years per year. I mean, it's just terrible. I mean, they're just doing...
Just in case someone's listening and thinks that you're not being sarcastic, I'll share the numbers with our audience, shall I? Would you like me to do that? Yeah.
Please,
okay. Comp sales for the fourth quarter up 12.6%. The estimate plus 8%. EPS 259. Lisa, the estimate 244.
Came in much better than expected, and interestingly, sales came in better than expected, but so did earnings. Sales revenue came in much better than expected, whereas earnings per share not as much, but still beating. Again, margin compression on the margins, but still sales are so strong that it really
They're up 29% per year from the bottom of the pandemic because we're never going in a McDonald's restaurant again. I mean, I'm there 4 times a week.
Stock is up 2.6%.
It's terrible.
You're just dripping with sarcasm this morning,
I've said this. Come on, I've said this for 2 years. I want a victory lap here. Corporations adjust.
They adjust, and
that's
after
what's
they do,
going
they
on.
adapt.
Okay, fine.
Thank you. They adjust and adapt.
He gets extra pay to say adapt like that. I mean, it's just
victory lap.
If we could clip that, is that Tom's own victory lap?
Yeah, this is his
No, it's
victory
Tom's
lap.
victory
He just
lap.
said, give me a victory lap.
Come on.
You
I'm
toast yourself.
sorry.
Have a
This
drink.
is McDonald's. It's terrible what they're doing. I think we should all have lunch there.
The stock is up
Thank the whole
2.4%. You go celebrate, okay? The market looks like this morning. Good morning to you. Let's whip through it. Equity futures negative, down a third of 1% on the S&P. Softer yesterday on the Nasdaq, biggest one-day loss of the year so far. Year to date, though, still up 8 or 9%. In the bond market, not doing much. 353 on a 10-year. Euro dollar 108.35. Lisa, we're negative there, a little more than a tenth of 1%.
Today's going to be really interesting. We've been really celebrating what's going to happen later in the week. But today at 8:30 a.m., we get the employment cost index for the fourth quarter, and we start to get a sense. Typically, this comes in a bit hotter than what we've seen on the wage increases. How much are we seeing a deceleration for how much the expenses for employees is going up year on year? And we're seeing that with the earnings that we keep getting. The costs are going up. Caterpillar eating into the margins there because of that. 9 a.m., we get a sense of housing data, including the S&P CoreLogic price data for the month of November. Here, the question is, how much pain have we already seen priced into the housing market, and how much do we see a plateauing? I mean, if you talk to economists right now, you're getting a sense perhaps the worst is in. And if that's the case, this doesn't really do much to ameliorate some of the inflationary pressures that the Fed would like to see abate. And we've been talking a lot about the earnings, and I think that the earnings probably are some of the most important important data points. We get Snap, Electronic Arts, Advanced Micro Devices, and Western Digital all after the bell. But John, as we've been talking about, we've gotten McDonald's, we've gotten Caterpillar, we've gotten GM, and it's not a clear picture coming out. You are seeing margin compression at Caterpillar, but GM's still crushing it. So how do you put this together?
You mentioned Snap. It's up 24% year to date. Meta's up
Year to date.
22% year to date, which is like 4 weeks, Tom, in a couple of days. Isn't that crazy?
Well, yeah, but even with EVs, Snap-on Tools is going to do great.
I'm not biting. And Angela Dyer joins us now, Global Equities Portfolio Manager at Invesco. You knew what I was talking about. And Angela, is this the real deal? And good to catch up with you. This rally we're seeing in some of these tech names, is this a real deal? Something you want to buy and hold?
So thanks for having me on, Jonathan. And good question, right? And the thing with bear market rallies, whether it's the real deal or not, is you really don't know except in hindsight. There's been a lot of data parsing done around this. But here's what I will say, right? The world is in a much better place today than it was 4 or 5 months ago. A lot of the apocalyptic scenarios have gone out the window. And simultaneously, on the other end, valuations have come in tremendously. And specifically with tech, I think we're looking at two very divergent buckets. One is the very good companies that have really good business models, high barriers to entry, are copious free cash flow machines. And there's obviously a lot of cyclical headwind. Customers aren't feeling so great. You have to work through estimates, et cetera. But arguably, some of these valuations are at a point where you're paid to take that risk. And then the other bucket of tech, which has been sort of, the biggest victim of the Fed raising interest rates because they've been long duration stories, that bucket is now painted as a, guilty till proven innocent. Rightfully so in many cases. They have to demonstrate that they can wean themselves off of the spigot of free money that we've enjoyed these past many years. But even then, there are probably some babies that have been thrown out with the bathwater.
I'm fascinated, at Princeton, the intimidation of sitting in a class with Alan Blinder. He wrote a brilliant essay in early January for the Wall Street Journal. And he said, what if inflation suddenly dropped? How does your world change if we get what Blinder's talking about and inflation suddenly drops?
Inflation is the thing, there's short-term inflation in the goods sector that's already started dropping, right? And I think what we're waiting to the point you were alluding to earlier, the shoe we're waiting to see drop is the tight labor market. So those are the short-term pieces that we think we'll see some leeway on anyway, and that's what the market's pricing in. But there's a longer view to be made, since we're talking academia, that there are a lot of structural forces at play that are not going to bring us back to 0% or almost no inflation, just, with the flick of the Fed's wand. The demographics are what's causing a tighter labor market. There's deglobalization, sort of the geopolitical harmony that led to all the globalization of the past 20 years seems to be dissipating. So I think we're underwriting to a base case of inflation not going back down to the lows it was immediately. And that's okay.
So what's the Invesco sum total return internationally? Are you looking at it weak single digit, mid single digit? Can we be more enthusiastic and reach out to double digit returns?
At the index level, you had this conversation just Friday, I think. It was fascinating, right? At the index level, nothing looks particularly spectacular, but below the index level, it's an entirely different story. We've had companies, since you mentioned Europe, that are bottleneck companies. They control an important bottleneck for massive amounts of global activity. They've been solid compounders for a long time and have structural trends in place that will continue to let them do so. So on a stock-by-stock, bottoms-up basis, we see plenty of opportunities for very strong returns.
On an overall basis, though, how much of the trade for 2023 has already been put in, right? I mean, this is really the key question because everyone's been long Europe. Everyone has seemed to flood back to the tech stocks that were thrown out at the end of last year. Are we done with, and I don't want to say this because I'm going to get pilloried, but the easy gains, right? Is the easy money of 2023,
Is
gone?
it ever easy?
It's always easy. Let's go on. Let's move on. No, but seriously.
If you look stock by stock, which is what we do as active investors, not activists, the easy gains are not done because there are lots of companies trading at valuations where they're priced for the apocalypse, really. Europe, for example, 6 months ago, people thought they were going to run out of gas. Even companies that made medicines, right? They were pricing in a scenario where they would just have to stop. And obviously, a lot of that has unwound. You've seen that this quarter. But as you look at valuations and company positions, a lot of that is still left to come. Again, stock by stock, right? I'm not talking index level. And then the other thing about the Fed raising interest rates that's unheralded a little bit and unsung is it reduces competitive intensity. A lot of good companies have had these ankle biters in their sectors that have just benefited from free money and have slowed the pace of things. And we think a lot of companies are actually going to rebound structurally stronger from this.
Used to call them disruptors. Remember that, Tom? Disruptors. Disruption. That was like the buzzword for
You got to have 7
10
years of Princeton and Harvard to say ankle biters. And
ankle biters.
She's right. Absolutely dead on.
You're an ankle biter.
I am. I mean, it's a massive shift here to risk-free rate. I mean, frankly,
more ways than one.
People forget. People forget. This is important. People forget what it was like to have a real interest rate regime. It's affecting everybody at every moment within society.
There's still so many people, Tom, who think we're one rate cut away from boom. Back to tech leadership.
Yeah, I think. I'm very curious of your belief that it's different this time for international, and that there's been so many failures of the international enthusiasm. Is it different this time because of the yield shift?
So what I will say is, I take your point on the index level, but I'm talking about the below the index level where it's always been different, right? Some of the best performers of the past 5 years, even versus the NASDAQ, and maybe it's unfair just given what we've been through with the NASDAQ, have been international companies. There are companies in Europe especially, in healthcare, in semiconductors, et cetera, that have a stranglehold on economic activity in their sector, and they've just continued to get bigger and better, and it's been reflected in the share prices.
Ananya, this was great. Ananya Ladaya there of Invesco, thank you. Up next on the programme, we're going to talk to Norway's Wealth Fund, the head of that fund, Tom, and what a difficult time. Woof. So we were down 15% on stocks over there, 12% on bonds, and that was equal to $164 billion worth of losses, Tom, and a $1 trillion fund.
I saw the numbers for Norway, and I said, it's index performance. That's how... I thought they did pretty well versus people getting cratered.
Their mandate is to track the index.
Yeah.
Where do you hide if your benchmark?
And how do you move the needle?
That's going to have a really potentially.
Let's buy Denmark. That'll move the needle.
You trying to cause trouble?
No, I'm not. Of course
War.
Not.
The CEO of Norway's Wealth Fund joins us next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. For the first time in a year, the International Monetary Fund has raised its global economic growth outlook. The fund says the world's gross domestic product will probably expand 2.9% this year, and that's 0.2 of a percentage point higher than the October forecast. The outlook was boosted because of resilient U.S. demand and the reopening of China. The Eurozone is on track to avoid a recession. The region's economy unexpectedly grew by 0.1% in the final quarter, despite double-digit inflation and Russia's invasion of Ukraine. Output in Germany and Spain shrank, but France and Spain recorded expansions. The U.S. and South Korea plan to step up the scale of military exercises that have angered North Korea's Kim Jong-un. The drills have been scaled down or halted under former President Trump. In the past, North Korea responded to the drills with threats and weapons tests. Shares of ExxonMobil are falling. Full-year profit was a record $59.1 billion, and fourth-quarter earnings beat estimates. But revenue came up short. Plus, Exxon didn't announce additional share buybacks. The company kept its quarterly dividend at 91 cents per share. And earnings at Caterpillar missed estimates for the first time since 2020. Rising costs hurt the maker of the iconic yellow bulldozers. Caterpillar is seen as a bellwether for the broader economy since its machinery is key for the construction, mining, and energy sectors. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Britain's next.
It was going to keep rating World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. The Fed is expected to dial back to a 25 basis point hike.
They want to make sure they don't go too far.
Pivotal moment to make some decisions.
But will they go so far as to signal a pause?
We have a long ways to go.
Trust Bloomberg for the fastest coverage and exclusive analysis, including former Fed Vice Chair Richard Clarida.
Recession fears are tangible.
What's the mistake this year? Doing too little or doing too much?
Stay tuned. This is going to be with us for a while.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. Your global business authority.
The worry is more with what we call core inflation that excludes energy and food prices that are typically more volatile. And these core inflation measures have shown more persistent, and they have not peaked yet in many countries, and they're still far away from central bank targets. So the job is not done.
That was the IMF chief economist. How many times will you hear that phrase over the next couple of days? The job is not done. From the ECB President Christine Lagarde, from Governor Bailey over at the Bank of England, or from Chair Powell, for that matter, over at the Federal Reserve, all three making decisions in the next 48 hours or so. The IMF sees a turning point in the global economy. The market's already seen that over the last 3 months or so. Looking at this market, what a rally to start the year. Equity futures right now on the S&P down 1/3%, still up over the last 4 weeks or so by more than 4% on the NASDAQ at the close yesterday. As of the close yesterday, Tom, up something like 8 to 9 percentage points. Year to date, it's been quite a run.
It's been quite a run, and it's a run wrapped around the mathematics of indices and the mathematics of what to do forward coming out of a pandemic. And if it's scope and scale, maybe no one has it like the Norway Sovereign Wealth Fund, the Norges Bank Investment Manager is with us right now, Nikolai Tango, when he speaks. All of Europe listens, and frankly, all of the global community listens as well. Nikolai, I think the headlines are wrong. They don't mention the scale that you have where you lose 50 billion, 100 billion, 150 billion. Who's counting? They don't understand the mass. Given the size of investment you manage, how do you move the needle for 2023?
Well, first of all, we are a relatively index-near fund, so of course that's the main thing. We invest according to an index given to us by the ministry, but we also try to tweak out some excess performance, and that's what we did last year. We had more than 100 billion Norwegian kroner in excess returns, and that's what we work hard to do.
On sector basis, how do you move, given how tight your R-squared is to a given index that you look at? What micro decisions can you make to recover and maybe go in excess of an index return?
Well, what we did last year was that we were overweight the integrated energy companies, which did well, and we also were underweight recent IPOs because the market seemed really frothy in 21. And so we underweighted those, and a lot of those did really badly last year. So that saved us some money as well.
You talk about being defensive in 2023. What does that mean, Nikolai?
Well, I think 2023 is much more difficult to call. You know, coming into 22, we had a more of a careful stance. There's less of these extreme situations to look at now going into 23. So we are more equal weight generally. It's a very tough market to call.
Is there a lot of pressure within Norway to shift the mandate away from being so closely tied to the index, so subject to the flows of the macro world, and move into private assets, whether it's private equity or real estate, and expand that bucket that you already have?
No, I think it's very, very important for a very large fund like this to actually be quite index near. Because the thing is that if you are too far away from the index and you make big mistakes, the losses are going to be so big that nobody's ever going to keep the job. So it needs to be index near, it needs to be anchored with politicians and in the parliament.
So what are you expecting, what are you preparing the residents of Norway for in 2023 in terms of returns if you don't feel very confident that you can get back what you lost last year?
I think it's important to make sure that everybody understands that we will not have a repeat of the last 25 years. We had a period where rates were coming down, where globalization was going really well, and we are now in a very difficult, very different situation. You know, you're seeing a reversal of the globalization. You're seeing rates having moved up, and it's of course very unclear where they're going from here. So returns going forward will be different.
Nicola, I'm really honored to ask this question, given your hedge fund expertise and moving on to serving Norway with the huge challenges of jillions of dollars of money, your philanthropy, etc. What do you think of America's fixation on windfall profit taxes? Does American hydrocarbons need to be more like what I read about in European hydrocarbons? What do you think of a windfall profits tax?
You know what? The one thing I have learned in this job is that I'm not supposed to have any political views whatsoever. And so I think I will pass that question on to somebody cleverer than myself.
See how he's pro.
Yeah.
I mean,
he's very media trained, Tom.
Yeah, he's very media.
You don't touch that one.
Savvy. He didn't touch that one at all. Then I'm going to look, Nikolai, at what we do forward here if it's just an index fund and participate. I want you to talk to our people who have not participated in the bounce up in January. They're scared. You know, we make a joke here, Nikolai, about the triple leveraged all cash fund. How do people scared stiff participate at an index return level?
You know, I think the very big question this year, I mean, the $1 trillion question is what will happen to global inflation when China really comes back on stream, when they start to consume the way they have done in the past and so on. Will that drive raw material prices, and will that impact inflation in the rest of the world so that the tightening will continue and perhaps even accelerate? Because that is the biggest risk to equity markets. The market does not expect that, and if that happens, we will have a big leg down.
There's a question about simplification and whether it's a time to simplify. And Nikolai, I know that the Norwegian Sovereign Wealth Fund is talking about reducing significantly the number of companies that it's investing in. Why is that important? Why is that simplicity a main goal of you?
Well, I think it's really important because for the moment we own 9,000 companies around the world. We know, we own roughly 1.5% of all the companies in the world, but 9,000 companies. And the one thing you can be absolutely sure about when you own 9,000 companies, if something goes wrong anywhere in the world, you own it. So to go from 9,000 to 6,000, I think it's just going to be great. It got minimal effect on diversification, minimal effect on returns, but just reduces complexity in the whole organization.
Nicola, I wanted to finish on, I think, the major question for you guys, and you touched on the heart of the big risk for 2023. That's inflation and the potential that inflation is sticky, because the big losses last year weren't just that equities were down, it was that bonds were down too. Nicola, do you have any degree of confidence that this year the more intuitive relationship between bonds and equities reestablishes itself?
Well, it's certainly more likely to reestablish it when rates are higher. I mean, we came into last year with a return on the bond portfolio of 1%. We ended at 4.1%. So that normal relationship is much more likely to hold this year than it was last year.
Is sticky inflation a threat to that?
Yes, it is. I do think sticky inflation is one of the big threats we have here. Having said that, it's certainly a known unknown. And the thing that really spooks the market is always the stuff you never expected. The financial crisis, the meltdown of, the nuclear situation in Japan, or the COVID, the kind of things that you've never seen before, where it really causes a lot of fear. That's the real risk.
Is there one you're discussing around a table right now that you don't think people are talking about enough?
No, I think the really scary stuff is the thing you haven't even thought about.
Nicolai Tangen of Norges Bank Investment Management. Thank you, sir. That was just for Bramo at the end there, TK.
It was.
Sticky inflation, though, for many people. I mean, Andrew Ball said this last week over at PIMCO.
That's good.
The fact of the matter is, if we stay at about 4 to 5, you've got a problem. And the thing that's haunted many of these guys is that we've got losses on equities and on bonds. for pretty much every single asset manager across the board.
Unique back to 74, and I've seen some people take the bond debacle back to 1788 or something as well. I think, not to be critical, but on a relative basis, it's underplayed how well Norway did last year. I mean, is it a home run? No.
On the bond side or the equity side?
Both, frankly. I don't. I think on the bond side they maybe did better than indices, but for them to perform and come in -14, look at everybody else's portfolio.
He's made the point a few times. They own almost everything. The big decision for them, Lisa, is what not to own.
Exactly, and they're going to try to cut some of that potential risk that they might not know in some of those companies of the 9,000, more than 9,000 they currently own.
Norway's Sovereign Wealth Fund, losses equal to $164 billion. The fund now 1.3 trillion. Coming up, Mike Schumacher, the global head of macro strategy over at Wells Fargo. We'll talk the bond market, the Federal Reserve, the ECB, and the BOE, all coming up, going into payrolls on Friday. That's next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The week begins tomorrow. The Federal Reserve decision just around the corner. Going into it, the two-day meeting for the Federal Reserve begins a little bit later this morning. Going into that, equity futures a bit softer. Equities yesterday a whole lot lower. On the S&P, we're down 0.25% this morning. On the Nasdaq 100, negative 0.4%. Tons of earnings. Lisa will get to that in just a moment. Here's the shape of the bond market for you: 2s, 10s, and 30s. Over the last couple of weeks, I have to say, really stable on a 10-year, on a 2-year, on a 10-year, in and around 350. Right now, yields lower by a basis point, 352.35. The 2-year in and around 420 for much of the last several weeks. Yields unchanged at the front end, 423. Want to finish on euro dollar going into the ECB on Thursday, looking for a 50 basis point hike. Euro dollar 108.38. In at around 108, 109, with inflation in Spain coming in hot, still elevated in France. And TK, seemingly the ECB just ready to go 50 again, and maybe even teeing it up again and again.
It's the parlor game, and it's played out over there differently than here. I think England's being ignored now. I don't know if there's a parlor game in Japan, but they're going to blink here, as you mentioned, in March or April. And it's just great uncertainty waiting for data. What's the data that matters? Without question, it's wage inflation.
For Governor Kuroda, Tom, for the BOJ, you mentioned it, his last meeting in March. If you were taking over from the BOJ, what would your preference be? Would you prefer that the previous governor just set policy on a new path, or handed over the mess of that balance sheet?
My preference would be to listen to the political landscape in Japan as they confront for the first time in generations tangible inflation, far more than anything we're feeling.
Lisa, all of that coming up in the next month or so.
Right now, though, we do have earnings. We've had earnings throughout the morning and throughout the week and throughout last week, and I find these earnings completely fascinating. I got to be honest. Pfizer came out, and I know we don't really talk about the pharmaceutical sector that much, but what I find interesting is that revenues are going down so significantly for COVID-related vaccines, COVID-related remedies. This, to me, really raises a question of what risk we have going forward if people aren't getting their different boosters. And we can get into all the controversy around the bivalent, the covalent, the trivalent, and whatever else. But either way, aside of the Times, those shares lower by 3% ahead of the open. UPS shares, interestingly, up about 2%. Basically, this is a story of steady margins. This is a story of cost cutting. Their actual revenues came in just a touch lower than the street expected. However, they are doing cost cutting enough to bring their operating profit margin up beyond the expectations. How much is this going to be really the story of the winners of this year? And McDonald's shares lower by 2%, which is kind of interesting because they beat expectations across the board, both on revenues and earnings, and yet those shares have underperformed pretty significantly. How much, again, though, is this what has been priced in? Because last year McDonald's was a massive outperformer. It was only down, about 1.5% versus the overall pretty massive declines that we've seen. Those shares at $265.32. And I just want to end on GM because we are going to be speaking with the chief financial officer in just a moment here, Paul Jacobson, about what they delivered. Those shares surging almost 5% after delivering beats across the board. Now the question is, what's the backdrop in terms of price cuts and the price wars that we've seen so far?
Can I get a cheaper Hummer?
You strike me as a Hummer person.
Yeah.
Yeah.
Can I get a cheaper Hummer?
Is that your goal?
No. Who drives a Hummer, Tom? You know somebody who drives
John
a Hummer.
Tucker.
John Tucker does, doesn't he?
No, he does. It's been
in radio. Did
he
you
had
know
it in
this?
the garage for a while.
No, John.
He really does.
He has a Hummer.
At $5 a gallon, I believe he put it in the garage.
Did he?
Yeah, I think.
Oh, he stopped driving it now.
Yeah, for like 3-4 months, but I think he's.
Did you not know this?
No, is it electric?
Well, he lives on the beach.
No, I think he's looking.
Loves it.
I don't think he can get one. Even he's with Bloomberg Radio. John Tucker is so magnificent. He can probably get in front of the line, but he hasn't.
That's going to be the first question. Yeah. Do we get price cuts? Busy week for central banks, not just for auto dealers. The Federal Reserve leaving investors bracing for a downshift. Mike Schumacher of Wells Fargo saying the following: our bias is to expect risk to be tilted towards higher rates and a stronger dollar around the Fed announcement. Tom, any hawkish comment from Powell along the lines of we will keep rates high for an extended period might be met with indifference from markets unless next week's ECI data surprise meaningfully to the upside. We get that data, Tom, a little bit later. That's going to be important.
It is. This is important. I'm a big believer in ECI data because it folds in wages and benefits. It's got some real sophistication to it, maybe compared to average hourly earnings. Mr. Schumacher joins us now with Wells Fargo, Global Head of Macro Strategy. I'm going to look, Michael, here, ECI data, and maybe that's what brings a 10-year out of its doldrums. The doldrums, you think, folks, of the equator in boats of centuries ago staying flat in the water, and that sure feels like the 10-year yield right now, or the real yield as well. Where's the real yield in a year? I need an actual Wells Fargo bet.
Real yield in a year on 10s, Tom, 150 to 175, something like that. It's been having a tough time getting sustainably above 1.25, sort of stuck in the doldrums, as you mentioned. But at least in our view, the Fed wants to see real yields higher, really to make sure inflation is down and stays down for a while. So 150 plus at the end of the year.
My study of that is normal ages ago was 2% or maybe 2.05%. I'll let you, as the pro, give me a better number. What are the ramifications if in this cycle the real yield only gets halfway there? I mean, it's just not going to go out to the fear levels people are talking about.
I agree. You know, going back 20 plus years, let's say, 2% plus on reals was pretty typical, made a lot of sense, whether in Fed funds, whether in 10s. But you still have central banks so active in the bond market. Yes, I get it. The Fed's cutting back, et cetera. But nonetheless, the Fed and other central banks own so many bonds. They've really distorted that relationship and brought yields down. And it's basically a secular decline. So pushing reals up to 150, maybe 175. Historically, it's still somewhat low. But versus the last few cycles, pretty tight and much tighter the last time around.
Mike, what's going to push 10-year yields higher?
I think a couple things, Lisa. One is actual rate hikes out of the Fed. The Fed will do the usual stuff. Powell's going to talk about, yes, we're not going to switch quickly into easy mode, but the market's heard that time and time again, very consistently since Jackson Hole, tunes that out. But you get a rate hike this week, a rate hike in March, people start to say, the Fed's actually serious about pushing rates up a little bit more. And oh, by the way, it's not so likely to switch into easy mode. And I think having the economy, we saw this with GDP, not roll over quickly, gives a bit more of a boost. So it's those things. It's really more Fed, tangible activity, tangible rate hikes, combined with economic data that show a bit of weakness, but not a real collapse anytime soon.
So here's the conundrum for people who typically looked at weakness in the economy as a reason to pile into bonds, not exit them. Are we moving into a scenario where it's the opposite on an ongoing basis, where people basically move away from bonds in the sign of weakness, even though that could mean recession, that could mean lower inflation, and it could mean a haven trade is back on?
I think it boils down to the inflation call, and it was an interesting question you posed to the last guest from Norway. Do the correlations normalize going forward? At least in our view, if inflation stays high, you probably get correlations that are still very much out of whack. But if inflation were to drop down a bit, then I think you get people really reasserting that typical relationship with bonds being a safe haven if equities suffer. But until that happens, not so much. So I think it's probably a couple months out from really making a good judgment on that.
What will you listen for in the press conference? I'm already looking out here. I've got to look it up, folks. I'm sorry, I don't have the dates mentioned. March 22 and May 3rd. How will you listen to the press conference tomorrow, Michael Schumacher, trying to frame out the guesstimates of the next two meetings?
If by some odd chance Powell actually is specific in terms of framing potential rate moves in March, that's going to be huge for sure. But I suspect, Tom, we're not going to get that much out of the press conference. From our perspective, frankly, the more interesting meeting this week is the ECB, because the market is so teed up for a hawkish response. Right. And the ECB has been very clear it's going 50, not this time, but potentially going forward. And we're actually skeptical about that. We think that's unlikely. So I think the more action, more interesting action is going to be ECB day, less on the Fed day.
X the war and the daily trauma of those headlines, does Europe have the oomph to enjoy a higher rate regime?
Not really. So if you think about the European economy over the last, call it 10, 15 years, it's been characterized by very, very low growth. Italy's had no growth in 20 years. Does that automatically switch if the war ends? No. So does Europe somehow figure out a way to get out of this low growth environment? I doubt it. And that would tell us that, ignoring everything else, you would expect policy rates to be higher in the U.S. and probably the U.K. than continental Europe. But it's going to be a while until that happens. So the immediate concern from the ECB is, what do we do about this inflation thing that we've ignored for a long time? Now we have to fight it. And by the way, the ECB's mandate is headline inflation, so it's got more volatility. But as far as long-term, no, the European economy will not grow like the U.S. or most others for that matter.
Mike, I want to issue a mea culpa. Earlier in the show, Tom told me that I skipped the lead, that I buried the lead when it talked about the IMF and what they came out with, that they really just really shunned the United Kingdom and how difficult that situation is. Why do you hate also on the pound and what's going to happen there in that economy?
Yeah, frankly, Lisa, when you look at the UK, it's got so many difficulties right now. So inflation, yes, we know that story. The war, sure, we get that. Commodity prices, tough. On top of that, you've got the Brexit hangover. Don't have trade agreements with the US and many other countries. So in many, many dimensions, the UK has got a huge political problem. And the Bank of England is looking at it and saying, what do we do? We're not really sure what the inflation path is, nor is any central banker. In addition to that, we've got this very funky political response. So I'd say the most likely course of action for the BOE, it hikes a bit more and stops and waits. So the path there is just much more convoluted than for other central banks.
Technical term, that one, Tom. Funky. Funky political
Yes, in Paris it's funky.
Do you like that? Mike, thank you. We're going to let you go. Mike Schumacher of Wells Fargo. Ending on the UK there. Can I pick up on the United States? The IMF has got a forecast now for 2023 GDP growth for America of 1.4%. The Federal Reserve has a forecast of 0.5%. I'm very happy you brought up the March meeting, because in the March meeting we get new projections, and I wonder what those projections are going to look like for both growth and on inflation.
We'll look at the data.
And that really is going to be the tool to push back against market pricing for rate cuts. So the meeting in March, Tom, I think more significant for a lot of people.
And huge data significance here, and we got a whole set of data here 2-3 days out, but then, I'm sorry, inflation data into February is critical. And I'm going to go back to the great Liz Ann Saunders, who said the mystery for her is housing. Can you imagine if you actually get housing disinflation? I mean, no.
Or if you get a re-acceleration and a pickup, Lisa, because rates have backed off.
Well, but that's exactly the problem, or the gain if you own housing and are invested in it. But there still is plenty of money looking to buy stuff, looking to take advantage of that. And we hear that every day.
March 22nd, where are jobless claims on March 22nd? Right now, 186,000. Are we still in and around 200K by the time we get to March? In that case, this Fed
has to keep going.
You'd imagine it keeps going, Tom, if it's worried about the outcomes and consequences of a tight labor market.
What I'm hearing consistently is it's a fully employed America. That's what I'm hearing.
Interesting conversation coming up next. Paul Jacobson, the CFO of General Motors. Earnings this morning, pretty decent. The stock flying. And a big question for many of us, where are the price cuts? That's next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The White House will end a pair of COVID emergency declarations on May 11th. That will mean the end of the controversial Title 42, a policy that expanded expulsion powers at the border of the U.S. and Mexico. The emergency declaration also allowed millions of Americans special access to Medicaid, the program that provides health care to low-income people. In China, manufacturing and services expanded for the first time in 4 months. The country's reopening from COVID-0 continued, and the Lunar New Year holiday spurred travel and spending. It's welcome news for the global economy, which is cooling and will rely on China's recovery to offset other risks. Brazil's former president Jair Bolsonaro is in no rush to leave Florida. Instead, Bloomberg's learned he's applied for a 6-month visitor's visa. That's making life uncomfortable for the White House, which will welcome Bolsonaro's successor and bitter rival Luiz Inácio Lula da Silva next month. General Motors expects its earnings momentum to grow this year. The automaker reported better than expected profit in the fourth quarter. GM is counting on continued demand for its highest profit margin SUVs and trucks. It's also expecting higher production levels as supply chain issues fade. And Spotify reported fourth quarter subscriber growth that beat estimates. Gross margin also was better than expected. And ad-supported revenue at the music streaming giant climbed 14% at a time when brands have slowed down their spending. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
Here we're going to have a short and shallow recession, plain vanilla, garden variety. It's totally delusional. I mean, it's totally delusional because we're not going to have only inflation. We're not going to have only stagflation. We'll have a stagflationary debt crisis, the worst of the 70s and the worst of the post-GFC period. That's what's going to
Muriel,
happen.
I got to say, you're not helping with my anxiety levels right now.
I'm going to go. I'm moving my portfolio to cash. 1 second. I got to pause the
Well,
podcast.
cash is not enough because it's wiped out by inflation. You have to go to assets, and I can discuss they can hedge against inflation.
Stagflation already seems like the nightmare scenario for central banks if you have high prices and lower growth. But if you tack onto that a debt crisis plus stagflation, that just seems like incredibly difficult for any central bank to navigate.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
General, when it comes to semiconductors, we see the challenges of the last years ease, so supply is clearly picking up. In general, we see costs coming down, maybe not to normal levels. Also, energy costs, of course, still higher than a couple of years ago. But overall, we see the cost pressure coming back from the challenges we've seen maybe half a year ago.
Martin Sander there, the general manager of the Ford Model E. A big question in the last couple of days. Are we going to have an EV price war in the United States of America? We'll pick up on that theme in just a moment. Equity futures right now negative on the S&P, down by 0.2%. Yields coming a couple of basis points on a 10-year, 351.79. A bit of economic data coming out a little bit later this morning. Tom, going into the Federal Reserve tomorrow and payrolls on Friday.
It's going to be interesting to see, John. And, you know, you look at the way the futures are in the data here today, and this ECI, which does hearken to General Motors, John, is about the combined wage pressures of wages and benefits
that
as
word
well.
sticky.
Yeah.
How sticky is that story going to be?
Yeah, it's going to be interesting to see the lesson. What we're going to do right now is talk to a C-class officer of a different cloth. He's out of Auburn and Vanderbilt, but very different. He's the only one in the automobile industry that tried to go to a quieter industry. He was at Delta Airlines for years, and the volatility of everything aviation. Paul Jacobson is the chief financial officer of General Motors, and Lisa's going to grill him on her need for an electric car. You need a GM electric car.
I'll let someone else do the sales pitch, but Paul, I am curious, starting with the airline industry and the price wars of yore, are we entering into a new price war of the electric vehicle ilk?
Well, first of all, Lisa, Tom, thank you for having me on. And Tom, I wore my Auburn tie today just for you. But I just want to say thanks to the GM team for everything that they did, overcoming tremendous levels of adversity, huge inflation results, over $5 billion of inflation to deliver the results that we saw in 2022. And, you know, vehicle demand for our vehicles remains quite strong for our EVs and for our ICE portfolio as well. So, you know, as we look at the business, competition is no stranger to us. We've been in the business for over 100 years, and I think the team is really good at competing. And where we see consumer demand for our vehicles at our price points is really strong. We just need to make sure we get production up to be able to meet that demand.
So you're saying basically you're not going to cut prices because you don't need to. People still are really requiring your cars regardless of what the price is.
Yeah, we have waiting lists for all of our vehicles as we roll out, and we expect production to ramp up pretty quickly as we get, especially into the back half of 23, to meet our goal of delivering 400,000 EVs by the first half of 2024 and 1 million EVs annually by 2025. We believe the demand is there and strong.
So how does this really pair with the story that we're seeing out of auto sales, with sagging sales, one of the worst years last year, going back in a number of decades as a whole, and people are talking about demand waning on the margins? Why is GM seeing such a different picture?
Well, I think, you know, a couple of things. One, the quality of our launches and the new vehicles that we've brought to market are really being received well by our consumers. I think our engineering and manufacturing teams, partnered with our supply chain teams, did a great job of increasing production last year by 25% over 2021. And we've been seeing vehicles move very, very quickly once we get them to dealers. We have seen some challenges in the outbound logistics. So this is after we finish a vehicle and getting it to the dealers. That's caused our inventories to increase a little bit. We're up to about 50 days of inventory. But if you look at the vehicles that are on the lots at dealers, they're about a third of what they were in 2019. Some of that is going to be, I think, permanent synergies, but some of that just speaks to how quickly vehicles are turning when they get delivered to dealerships. And that's a testament to the quality of the products we produce.
Paul, the aviation business that you were part of had a big turnaround where they started to be responsible about free cash flow, responsible to shareholders. We lost the volatility, the huge volatility, the craziness of aviation pricing. The fact is the automakers trade at single-digit price-to-earning multiples. You can use every other metric you have. Is there any pressure in the boardroom of GM to get a more persistent free cash flow that earns a higher PE multiple by the street?
Well, thanks for that question, Tom, and you know, thanks for highlighting kind of some of the work that we had done back in the airline industry. And what I would tell you is we spend a lot of time with the board on free cash flow in particular. You know, cash from operations and the cash generation of the business is what's funding our journey, and we've been very clear about that. So a strong ICE portfolio and a strong vehicle portfolio through the transformation is critically important to us. And you know, there's a lot of things I'm proud of the GM team for what they've done, but when you look at free cash flow generation on the backs of near record capital investment in 2022, I think it speaks to the focus that we have. $10.5 billion last year. We think we're going to generate another $5 to $7 billion in free cash flow in 2023, and that's with a couple $1 billion increase in capital expenditures at $11 to $13 billion this year.
I don't want you to be Apple here reporting on Thursday, but are you at a point where you can take use of cash and reward shareholders to garner a higher price to earnings multiple versus the ancient, back to Mr. Sloan, of piling it back into the business?
So we have a very balanced and prescribed capital allocation process, Tom. So, you know, the first thing that we're doing is investing in the business, and we have a lot of transformation work to do, as you can see from the capital that we've put in. But as we start ramping up EV volumes, as you start to see production of our Ultium cells at Cell Plant 1 and then Cell Plants 2 and 3 coming online, you're starting to see the benefit of that, because I think we're going to be incredibly well positioned for the growth in the EV market. But once we've invested in the business, we also have to make sure we maintain a strong investment-grade balance sheet. And, you know, at the end of the year and even early this year, we've early redeemed some bonds with that cash flow to help strengthen the balance sheet and fortify that. And we also, in the back half of the year, returned $2.5 billion back to shareholders. I think it's important to strike that balance because, you know, what we invest has to earn a return on invested capital. Yeah. But our shareholders and our bondholders have to see tangible results from that. And, you know, I hope to see more consistency in that across the board.
Paul, just to wrap up, we've been talking a lot about how the pressures between the fissure between the U.S. and China are really creating some headaches in the C-suite. From your perspective, are you looking to reduce GM's dependency both on infrastructure, on supply chains coming from China, as well as sales into that nation?
Well, you know, first of all, our China team has done a remarkable job. They had a lot of challenges in 2022 with the zero COVID policies, and we're obviously seeing, you know, a lot of some COVID slowdowns in late 22 and into 2023. But the team is really focused on that. We've got strong partnerships there. We've got strong GM vehicles coming to that market as well, and I think it'll remain an important piece of it. That being said, with the deal that we announced today with Lithium Americas and with work that we've done with Controlled Thermal Resources and Livent in the lithium space and POSCO and others, you see a much more geographically diverse supply chain building for some of those battery raw materials, and we're gonna be able to take advantage of that, I think, because of our size and scale and our willingness to work creatively with our partners.
Hey, Paul, great to catch up. Stock's up this morning by 4.7%.
Just because of Paul. Mary had nothing to do with it.
That was it. It was just that conversation, that 5 minutes. That's all that matters. Never mind 3 months of work. Just
that was a really responsible, but I think you really see the share usage there, the cash usage rather, where he mentions $2 billion return to shareholders, which is like a rounding error for UPS or for, name the other country. And I'm going to look here, folks, and this is the separation financially. Price to earnings ratio out to the end of this year, Bloomberg models GM, it's 6.37, and a small electric car upstart at 39.79. I mean, this is bizarre math.
That's been a story for a while, though, hasn't it, Tom?
Oh yeah, but I just growing up, in Autoland. I was on the eastern edge of Autoland, is how I would put it. Rochester Carburetor, can't remember exactly. Anyways, the bottom line is they've always got an excuse to reinvest in new product. Where everybody else is going, what are we going to do with the shareholders? I just don't get it.
Just to be clear here, no price cuts. Was that the takeaway from that?
That's the takeaway.
No
price cuts. People are still buying the cars that they have at the prices that they have.
We mentioned that earlier.
Well, no, we asked about it, right?
And he basically.
Oh yeah, he's a little more informed than we are, to say the least.
Mike Bell's coming up next from JP Morgan. You think? Equity futures on the S&P look like this: negative about 0.1%. A move off the lows in the last hour or so. Yields lower by 2 basis points. Your 10-year 3.5161 from New York City. This is Bloomberg Surveillance.
What are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. The problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind and open enough mind to be able to see around square corners. What am I missing? The why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Why is it that whenever there is like a scare coming along or a pandemic or something, people rush to buy toilet paper? You ever notice that? People are they're stockpiling toilet paper.
It's called hoarding, and it's one of those things you never want to be without.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I try and play that role.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
I'm not convinced that we're going to see inflation get anywhere near target as soon as the market would like.
We need wages to come down pretty significantly, and I'm just not sure that's going to happen.
If you look at the labor markets alone, yes, I think it's easy to conclude there's still upside risk to the Fed's path.
It's going to be a Fed that continues to talk about the need to do more.
The data is going to look encouraging, and the data on the road to a soft landing doesn't look very different than the data on the road to recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene together again in the 8 o'clock hour, an important hour of data here on radio, on television. And John, it's simple. Everybody in our opening says data matters. We all know it matters for Chairman Powell tomorrow. And in this half hour, we see key labor data.
It's funny, Tom, if you ask guests this week what they'd be more interested in, Fed Chair Jay Powell in that news conference or the economic data this week, spoken to a lot of people who say the latter, not the former. They want to see the data. And that makes it very interesting when it comes to this debate about rate cuts or not. Chairman Powell can say what he likes. That argument will be settled. That debate will be settled
by the data. Absolutely.
Data.
Totally agree. And on the ECI on radio, this really works where we get the handout where ECI data is like 0.95% is a moving average. We go down, some wage disinflation, spike up with the pandemic, and we've come down 2 data points. And John, the persistency year of a new data point down again will be critical.
Once we get through the ECI, then we've got the ISM tomorrow. ISM manufacturing.
First of the month.
Sub 50.
Yeah.
And that's the push-pull, the real tug of war right now. The survey data, the soft data, the ISMs, the PMIs are sub 50. And on the other side, I think the real test for the bear case at the moment just seems to be jobless claims, 186,000. That is like the test. If you ask any bear on the economy, yes, you hate the economy. Okay, please explain why jobless claims are 186,000. They struggle to do that.
3 days in a row. We're not going to do a brief this hour, but Lisa, it's real simple. We've got Feds tomorrow, then critical earnings from big tech. I guess they haven't disappointed so far, even with the pullback we've seen in the last 2 days. And then Jobs Day on Friday. It's nonstop here from 8:30 this morning.
The big question mark that might get answered a little bit is the consumer, because on one side, on the industrial side, the manufacturing side, you have seen a contraction. On the services side, you have as well, but not as much. And there was a Citigroup report that came out overnight that talked about how credit card transactions in January show the consumers keep spending in a massive way. They're seeing gas prices are coming down. That's giving them more discretionary spending. You see all of a sudden mortgage rates coming down. Suddenly people are going back into housing. That resilience still there.
And John, this is critical. And you mentioned the polarity of 2 of our guests here on economy, half glass full, half empty, the whole thing. Neil Dudd is suggesting with that disinflation, real income sustain, and that helps the consumer.
He sees a buoyant economy. He thinks this economy can pick back up. On the other side, Tom, is Steve Englander of Stand Chart saying we can pause at the Fed in March. He doesn't think we've got the data right now to make that call for Chairman Powell on Wednesday, but ultimately he thinks by the time we get to March, we will have that weak data in hand. Now, I remember that argument being made about the month of September. September 5 months ago. We were talking about September and the weakness that you would see that would be unavoidable, and this Federal Reserve would not be able to keep on going. And what happened to that?
Give me the statistic again. Ralph Van Campora talking about the October low, adamant. That's when the Dow Jones Industrial Average hit the low. John, you mentioned September, and you mentioned the European banks are up a ginormous amount.
Since the summer, sure.
Or the miners.
Take the miners from the last 3 months.
Yeah.
The lows of China in October. Alibaba's up like something 75, 80%. Something like that, Tom. Yeah. We've had a big rally off those lows.
And Curran writing up a Tom Orlick and team on China today, and to me that's another big mystery we've got. I mean, I'm sorry, but 3% China or 5% China is a huge debate into this Fed meeting and the following Fed meeting.
There's a hope, there's a fear. The hope is you import a ton of demand if you're Europe. The fear is you import more inflation. And that's the conundrum. What does that look like in a couple of months' time, Tom, by year end? I've got no idea, but that ultimately is what everyone is fixated on for good reason.
And Bramo, it's suitably a Bramo conundrum.
That is the Bramo story for 2023.
It is a Bramo story.
So everyone's excited about the good stuff from China, and Lisa's like, no, let me tell you something.
I'm sitting here worrying all about that. I can tell you about it later.
Let's get through the data quickly here to get to Michael Bell in London. John, I'm going to look at the sum of what I see here, which is still accommodative into the Fed meeting, but a little bit more restrictive the last couple of days.
It's a two-part story, Tom. Financial conditions have eased over the last month or so, maybe more than that, longer than that. The Federal Reserve Chair will be asked about that. If he says it's an unwarranted easing, the next part of the conversation is, okay, how does the market respond to it? Because this market's been ignoring Fed officials to some extent over the last few months.
Michael Bell joins us right now. He is in London and with JP Morgan Asset Management with Parchment from Queen's College at Cambridge. The guy holding court at Queen's College right now, Michael Bell, is Mohamed El-Arian, and he would talk about the game theory, the T decisions of the moment. What is your key T decision for JP Morgan Asset Management with the flow of news we have in the next 10 days?
I think ultimately we're going to be focused most carefully on employment numbers coming out of the US, particularly looking at whether we get weakness in construction employment, because we've seen severe weakness in home sales, particularly existing home sales, down pretty close to the 08 lows now. Historically, with a bit of a lag, you would expect that to feed through into weaker home starts, which is happening. And then with that, some construction job losses, which then tends to spill into a broader decline in overall employment. So it's those construction employment numbers that I'm watching most carefully.
Mike, when we get to March and the Federal Reserve meeting, Tom said, I think it was, what, Tom, March 22nd?
22,
March 22nd.
Yes,
Mike, when we get to March 22nd, where do you imagine the data is going to be? And would you see sufficient reason for this Fed to say, that's enough?
I think there's a good chance that they stop in March. There's a question mark as to whether unemployment has actually gone up by then. But I do think my base case is that we are going to see probably around the sort of middle of the year, unemployment rising in the US. And that's going to then give the market confidence that the Fed can deliver the cuts that are being priced at the moment.
Given the fact that we just keep wringing our hands and talking about how uncertain everything is and we can't really forecast or see very far out, how do you hedge, right? How do you sort of tentatively position at a time when potentially there are still big gains to be made, and yet there is so much uncertainty?
Well, I actually think the biggest risk to markets is that we don't get a recession in 2023. The wage growth stays high, and the Fed, having maybe paused for a bit in March, then in the second half of the year, they actually end up putting rates up by more than is forecast and aren't able to deliver the rate cuts that the market's expecting for 2024. So, you know, in that world, unfortunately, you're back into a world where both bonds and stocks would go down together. So I think you need to hedge using options rather than your kind of traditional diversification play.
Do you think that that's a likely outcome?
Our base case.
Do you think that's a likely outcome?
Our base case is that you're going to get a recession in 2023. That will allow wage pressures to moderate, and then that the Fed can actually cut rates in 2024. My best guess is the Fed are going to bring rates down to about 2.5% by the end of 2024, which of course is broadly in line with what the market's pricing now, give or take.
So, Mike, that's the US. If I could just jump in, can we just quickly squeeze in Europe and China as well, Mike? Where are you on international equities after 10 years of going around saying, finally, going to see some international outperformance? I say 10 years, I exaggerate, but you know where I'm going with this, Mike. When do you think we finally start to see international outperformance? And what do you see on the table right now that tells you some of these moves are durable?
So I'm pretty bullish on China. I ultimately think that, yes, it's rallied a fair way off the lows, but let's not forget it had gone down more than 60% from the peak, and we're still down about 40% from the peak. So I think that we're going to see a pretty V-shaped economic recovery in China in the way that we did in the West when economies reopened there. And I think that that's been partly priced, but not fully priced yet. I went around the country in Q4 of last year, and the amount of pessimism that I experienced from investors on China was really quite unprecedented. And so I think there's a lot of people who probably haven't closed those underweight positions yet. And as they capitulate, as China data continues to be supportive, I think you'll see Chinese stocks move higher throughout this year, although always not in a straight line, of course. Europe, I think, is interesting because there have been two fundamental improvements. Obviously, we've seen the reopening of China, which helps the Europe story, but also the massive decline in gas prices, down sort of 60% since September. But the problem is the market's reacted a lot to that already. So you were talking in the intro there about the sharp rally we've seen in European banks. I mean, both European and US banks were down 35% in October. The US banks are still down 25%, but the European banks have rallied a long way. So I'd have a preference for things like US banks over Europe at the moment, given how far Europe's rallied.
Mike Bell, Mike, great to squeeze that in. Fantastic to have you. Mike Bell there of JP Morgan Asset Management on the banking system in the United States and Europe. SX7E to get the European banks up, the banks in the Eurozone. That's the index. The low was in July, and since July 14th, Tom, we're up 51.3% on the banks in the Eurozone. That's a rally.
Well, some of it's beat down, but the rally also is a broad sense of stocks. And again, I would say just as a general statement, there's a real belief that there was a lot of gloom in shorting and, just gloom, forget about the shorting. And we've made that up. And the whole now what is to me just critical. And you see that in chart after chart where we're up against, and typically moving up, we're up against some significant resistance. How do we break through that? What's the metric that signals a breakout?
Yeah, the IMF getting us all excited with 0.7% GDP growth for 2023 in the Eurozone. The good news is it's not zero and it doesn't have a negative before it. But ultimately, it's the same old conversation after a rally, isn't it?
Well, is it? And especially with the European banks, which are up more than 15%. I was looking at the annualized equivalent, which would be more than 400%. We're not counting on that. It's not a straight line. But I am curious about how much of the bad news that was baked in for so long was because of negative yields, negative rates, and how much they actually stand to benefit from true yield, true income, true investment opportunities that can actually give them some revenue stream.
You would hope, because they've been complaining about that for a long, long time. What was it Mike Schumacher said of Wales? He said it's been like 20 years and there's been no growth in Italy. Why would that change?
Well, and then people have been complaining about higher rates, and then that's denting businesses.
I think he continued that forward. He said in Italy there's been no growth and no World Cup team.
Yes, I know. Okay.
I think
I'm surprised you haven't taken digs at me about AC Milan in the month of January.
They're struggling. They're struggling.
That's why we haven't been together.
That's doing a Tottenham.
Restarted after the World Cup, Tom, and that team, wow, if they lost some momentum. That is just ugly.
We call that doing a Tottenham.
I've offered my services, to go and consult them.
I have not offered my services to Tottenham.
Haven't you?
No.
You sure they don't want them, Tom?
No, they said to me, you can be a guy that sells the food pies.
You would be the guy that I came to in the transfer window. Like, who should we buy?
Oh, yeah.
And then you'd...
Is that going on right now? I see a lot of bodies moving around.
That's closing soon.
When they have those huge numbers, is that money to the team or money to the player?
No, to the team.
That's bizarre.
It's not like baseball.
It's totally
goes, and then the player gets a separate contract.
Do they make
Then the agents get all these different cuts, and yeah, it's pretty impressive stuff. We're in the wrong business, aren't we? Wouldn't that be fun? We'd be football agents. How do you think that would work out? Can you imagine? That'd be great, wouldn't it? All right. Seth Carpenter at Morgan Stanley coming up shortly.
Endorsement and careers or Greg's or whatever it's called.
Keep
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The Eurozone is on track to avoid a recession. The region's economy unexpectedly grew by 0.1% in the final quarter, despite double-digit inflation and Russia's invasion of Ukraine. Output in Germany and Spain shrank, but France and Spain recorded expansions. For the first time in a year, the International Monetary Fund has raised its global economic growth outlook. The fund says the world's gross domestic product will probably expand 2.9% this year. That's 0.2 of a percentage point higher than the October forecast. The outlook was boosted because of resilient U.S. demand and the reopening of China. The U.S. and South Korea plan to step up the scale of military exercises that have angered North Korea's Kim Jong-un. The drills had been scaled down or halted under former President Trump. In the past, North Korea responded to the drills with threats and weapons tests. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
Politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. The Fed is expected to dial back to a 25 basis point hike.
They want to make sure they don't go too far.
A pivotal moment to make some decisions.
But will they go so far as to signal a pause?
We have a long ways to go.
Trust Bloomberg for the fastest coverage and exclusive analysis, including former Fed Vice Chair Richard Clarida.
Recession fears are tangible.
What's the mistake this year? Doing too little or doing too much?
Stay tuned. This is going to be with us for a while.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
I know we can forge a path of building an economy where no one's left behind. It's about making investments in America's cities, towns, heartlands, and rural America. It's about making things here in America again. It's about good jobs. It's about the dignity of work. It's about respect and self-worth. And it's about damn time we're doing it.
The President of the United States, Lisa, tells me he's coming to New York today. Is that right?
He is. 11:45. He arrives on Wall Street. So if you want to move around the city, you might want to do it before
Yeah,
then.
farthest under Manhattan problems.
Exactly.
It's a bit of a New York
100%.
bias, but, you know, there's no love here for when the president comes to town.
So, true story, I was reading about him coming to town yesterday, and my son was there, and I was like, ugh, Biden's coming in. He's like, why do you say that? And I'm like, have you ever been on the streets of Manhattan when the president comes in or the UN is having a meeting? All right, I'm going to stop.
Yeah, Fifth Avenue
drives
and
me nuts
Madison
too.
so they can speed in.
I didn't realize until this morning, and now I'm just like, oh, for goodness sake, can I go?
New York Post with a nice summary here. I've just been skimming through here. Mr. Schumer, I guess, will be there. Total Hudson Tunnel costs $16 billion. This is a tunnel under the Hudson River. After the big dig in Boston, I'd go, maybe they'll nudge that higher over time. And what's really important, John, 12,653 minutes of delay they have had. And the New York Post knows that John Tucker of Bloomberg Radio, that was in 2020. In 1 year, they had 12,653 minutes of delay, and John Tucker personally experienced 8,367 minutes of that delay.
Do you have any comments on the infrastructure in New York City? Do you have anything to say?
Do
you know what he used to do to me when I came over?
What?
When I first came over, and Tom and I would be on air together, he'd sit down, and he knew exactly what he was doing. He was trying to get me in trouble with the audience. He would turn around and say, so tell me, what's your experience of the infrastructure compared to London? What do you think?
Come on, that's not fair.
What do you think? He would do it every single time.
We used to
every
say,
single time.
growing up, that you know how they say pothole in some places that actually have nice streets before you get a pothole? They should just put it before New York City. Just a really big sign, pothole.
I will say this, and this is from Boston. I can't find words for the first glance from Boston Center across to the north end when they took out the expressway, the 6 lanes of elevated highway across the Rose Kennedy garden that's there. And I knew everything about it. I knew all the math, Tip O'Neill Jr., blah, blah, blah. And none of it mattered for the impact of when they did that infrastructure project in Boston. I was stunned. Like LaGuardia now, we're all stunned at this dump of an airport. Looks gorgeous. What is that tunnel going to do? What is that
I do not understand still why JFK is the dump that it is. I just don't get it.
My amateur take is with LaGuardia, they gave the unions equity investment. If that's what it takes to do it in America, that's what you're going to do. It's an outrage compared to what you have in England
and
or in continental Europe.
Yeah, without a doubt.
Yeah. I mean, it's just terrible. I mean, there's no other way to put it. I think you look at all the expressways of Long Island, and they're an absolute disaster. And Amory Horton has been stuck on all of them and joins us right now, our Bloomberg Washington correspondent, not traveling with the president today. To Baltimore in infrastructure, to New York in infrastructure seems to be a habit. What's going on here? What's the real backstory, Anne-Marie?
Yes, and also this week, Kim and the Vice President will be going to Philadelphia to talk about infrastructure and clean water. You could say this is the president is just getting out of Washington and making sure the American people know about his legislative wins, but obviously that looks like campaigning, and that's probably what's going on behind the scenes. This is a president that is preparing to make an announcement for 2024, and what better way to do that than being the executive right now, being the president of the United States, and going out and explaining the legislative wins you've had, which was a bipartisan agreement when it comes to the hard infrastructure. And this is the kind of legislative work that American people like to see. They want to see you fixing railroads and tunnels and bridges. So that's a win for the president.
Okay.
Also sets him counterpart to what's going on in Congress, particularly in the House.
Baltimore, Democrat. New York City, Democrat. What kind of infrastructure do Republicans want?
I mean, infrastructure, Tom, I think wins across, right? You could say these states and cities are heavily Democratic, right? But these are also main GDP drivers of the United States. I mean, if you look at least for New York, this tunnel that they want to build under the Hudson, when you look at who goes in and out of New York City on any given day, pre-pandemic, that number is about 900,000 people. But also, the president was recently with Minority Leader Mitch McConnell talking about a bridge in Kentucky. So yes, what you're seeing this week is a democratically leaning states, but at the same time, he has also gone on the Republican side. But to my point, that this is a president that wants to prepare for an announcement of 2024, after he talks about one of his favorite things in the world, railroads, he's also going to be going to a campaign event, right? In terms of for the DNC. So that also makes sense why he'd be going to some of these Democratic leading places.
To basically cheer on the past victories and look toward a future run. In the meantime, in Washington, D.C., overnight, a lot of people talking about the potential banning, cutting off American suppliers from exporting goods to Huawei Technologies. There's a sort of domestic push on both the domestic front as well as the international front in terms of isolating China. How realistic is this? Is this really gaining steam?
Well, this was a great scoop by our Jenny Leonard, and we should really just give a little bit of context about what is already happening with Huawei in terms of the Commerce Department. So the Trump administration had put Huawei on a U.S. entity list. So pretty much all advanced technology could not be sent from U.S. companies to Huawei. And then you had the likes of Intel, Qualcomm, there's like these lobbying groups. They wanted to make sure that at least some old tech was able to go to Huawei. Now that you can only do that if you're one of these companies if you get a license. So right now there's going to be a pausing on the licenses from the Commerce Department, and then you have hawks in the administration talking about the fact that maybe this is too much of a carve out, and they're saying we should ban all of the technology that the likes of Intel or Qualcomm send over to Huawei. So this is getting a lot of attention in Washington, D.C., and it also comes as you have, a divided Congress, but a Congress that very much so is putting pressure not just on their own colleagues in Congress, but also the administration to take an even tougher stance on China.
AMH, thank you. Anne-Marie's such a New Yorker, Tom. She knew that when the president comes to New York, you don't come to New York. And she stayed down in Washington, D.C.
Yeah, she does. I mean,
that's just like the rules.
She's gifted. I mean,
she gets it.
She gets it. This tunnel thing, I mean, Lisa, literally the discussion's gone on for what, 30 years?
Yeah, I was going to say, this is a long time coming.
For our international audience, they've yet to move the shovel once, right? Am I right? It's really...
This is going to kick it off. This has been a real sore spot.
1910.
We need to rebuild infrastructure. To your point about why it's so hard, how do you build infrastructure when you already are using a lot of the stuff, right? Like LaGuardia was a pain in the neck to get to when they were building it because you had to go in through another area and go to a separate section to get a taxi.
Crazy,
and So, I mean, that's the obstacle. How do you rebuild something while keeping a city operational?
Can we do the subway next? Can we do that next?
Sure. I'll make a call.
Just clean it up, Bramo. Just clean it up. Do you remember when they said in the pandemic that they would start cleaning the subway every day?
And you
Do you remember that? And we all turned around and said, hold on a minute. What was the old cleaning practice?
Wait. Actually, back up. You said that. The rest of us said, well, yeah, wow, they're going to clean it every day.
All of a sudden, they're going to do it every day. What were they doing before?
Didn't you notice what it looked like?
Once a week. What was it before? Once a month? Anyway.
It's, compared to what I see in subways is a general statement around the world.
I just don't get it.
I just don't get it.
I just don't get it.
Where's the fury? Where's the will? Richard Haas was on the other day. I thought he was brilliant.
What did he say?
Where's the will? Where's the outrage? Where's, the will?
Do you want to start the outrage here?
No, I think Mayor Adams is trying to get the outrage going. The outrage meter isn't, too much.
Tom's going to be picketing around the studio. We want
seriously. Ask the
Yeah.
prima donna the last time I was on the subway, and the answer is I can't remember.
Wait, when was the last time?
There's a lot of people that have to take the subway. This is not amusing.
How many years has it been?
Oh, forever.
Like a decade?
Forever. Yeah, my people won't let me go.
We should do a trip.
I go all the time.
We'll do
I'll
a trip.
take you. I'll shepherd
Will you help us navigate?
Yeah.
You take the subway to Fairway, don't you?
Oh my God.
best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Moment news breaks. No one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
Bloomberg Surveillance, we welcome all of you on radio and television. Futures at -6, Dow Futures -55. VIX 20.22 as we get set. 10-year yield 3.53%. I'm going to make it clear, ECI is underplayed, and for me, it is always an important statistic. It folds in wages and benefits. It is, as an amateur, it is the statistic I follow, but far more importantly, we need to speak to the pro of the nuances of this. Seth Carpenter joins us from Morgan Stanley, but first, the pro, Michael McKee. What do you got?
Well, we got the employment cost index up 1%, which is a little bit lower than the survey estimate of 1.1 and down from 1.2 the prior month. Wages and salaries increased 1%. These are all quarterly numbers, and benefit costs were up at 0.8%. So on a 12-month basis, compensation costs are up 5.1%, wages and salaries 5.1%. So not a lot of difference between that and the third quarter. This is the fourth quarter's numbers. Benefit costs up 4.9%. So at this point, it looks like we didn't see a huge change in what's going on with benefits, wages, and salaries in terms of the fourth quarter. But this is a number that the Fed watches closely. It is obviously old data, but it gives them a sort of picture of where things are going.
Markets are moving. Dive into that. Mike's here with what do you got here? I got to lean over and see. Excuse me for being here. 47 pages of data on ECI. He's going to dive into the data. I'm going to tell you markets turn. Yeah. And of course they turn here, Lisa, into Fed Day. Tomorrow we go green on the screen. SPX up 4. VIX comes in as well. But the yield space is really where I see the movement. 3.51% in 3 basis points. Now lower yields is the construction coming off this data, and the dollar with a little bit of a bid.
Yeah, the fear had been that what happens if the employment cost index comes in hotter. It did not. The opposite. It surprised to the downside, which perhaps on the margins takes pressure off the Fed to raise rates even more. You see the yield come in not only on the 2-year space, but also even more so on the 10-year space, raising questions about longer-term inflation.
What do you see, Michael?
Well, if there is some good news in here you want to pull out, you take a look at the composition here of the wage gains. Goods producing industries were up only 1%, down from 1.3%. Not a surprise, given what's been going on in the sectors in terms of hiring, but service producing industries also up only 1%. And that's the area where the Fed has been looking for a lot of inflation. So maybe there's a suggestion that inflation in the service industries has fallen just a little bit in terms of wages, and that's what they want to see.
Does this change your press conference? Does this change the Fed meeting tomorrow?
It doesn't change the press conference.
Come on, give me some theater here, Mike.
It changes everything, Tom.
Everything.
You did a great job.
Instead of what everybody thought they'll do, they'll raise rates 25 basis points. Jay Powell will come out and say, we need to keep rates higher for longer. That's kind of, I think,
very good.
What we'll see with this big change.
It was okay. It was Oscar-worthy. Michael McKee with us, and of course, front and center tomorrow with our economic coverage. We take this data It's maybe the province of Ellen Zentner, but we'll take it on a more global scale with Seth Carpenter, Chief Global Economist at Morgan Stanley. Seth, I want you to fold, and I know you're going to read Ellen Zentner and her team here as they analyze ECI, but I want you to fold it into the great China call, which Morgan Stanley, back to Steve Roach, is expert on. Is China a 3% story, or is it a 5% story that could make things more complex for the chairman of the Federal Reserve?
Wow, that is a fantastic question. Clearly, the China reopening story is the big narrative going on right now in markets. And, we've been bullish there. I think we're above consensus, 5.75%, maybe a bit more in terms of how much growth we'll get for China this year. Very bullish for us. The reopening is notable. I think, though, when you talk about spillovers back to the U.S., when you think about what it does for Chair Powell, they're probably a little bit less dramatic than you might otherwise think. Clearly a big story for people who are investing in China and the region. But the spill back to the U.S., in terms of inflation, isn't going to be quite so big right now. We import a lot of consumer goods from China, but we know that consumer goods prices have actually been falling for the past couple of months as people have pulled back and redirected their spending. We also know that China had done a lot during COVID-0 to shield some of that production for exports. So the first order impact on inflation for the U.S. is actually going to be a little bit muted. The surge in demand there in China, domestic spending, especially domestic consumer spending on services. So the read-through this time around, this cycle, could be a little bit less.
Seth, I want you to dovetail a Morgan Stanley stunning 5.x% China growth call with U.S. disinflation. You and I follow Edward S. Hyman of C.J. Lawrence and Evercore ISI, and Ed Hyman's dovetailing a China call like you with substantial U.S. disinflation. Do you agree with that premise?
I think substantial probably overstates it a little bit. We are optimistic about inflation coming down in the U.S. We have it getting to below 3% by the end of the year. And just a quick shout out, you mentioned Ellen Zentner, our fantastic U.S. economist. Robin Xing is our stupendous China economist. And luckily, they're both on the same page here. The disinflationary push from goods inflation is clearly there in the data, and China is a part of that. But like I said before, the difference is going to be smaller than I think you might otherwise think. It really is this retrenching. And we saw it, for example, in automobiles. First, Tesla announced they were cutting prices. Rivian followed. Ford announced they're following it on electric vehicles. Adam Jonas, our autos analyst, points out that in the current situation, electric vehicle prices tend to drive pricing for new cars. So a lot of the disinflation that's going on from goods was already there, already starting. China helps at the margin, but I don't think it's going to be the defining story of the disinflationary trend.
What's the risk then, Seth, that perhaps people get overzealous by the decelerating inflation, the disinflation that we're seeing so far this year? Take the Fed off the table. The Fed does pause with rate hikes, and then inflation stays sticky, and they're forced to reignite and raise rates once again.
I think that is a risk that a month or so ago was dramatically underappreciated. We've tried to flag that risk a few times in our pieces. And so, yeah, the scenario you lay out, I think, is a plausible one. It's not at all the highest probability event, but it's, the next couple of months are very benign. But then non-farm payrolls go back up to 200,000 and inflation doesn't break through below 3.5%. I think it's a risk. I'd say it's not a very, very high risk, but it's one that investors have to keep in mind. And the only way we're going to know for sure is monitoring the data.
In the meantime, as we get the drip, drip, drip of the data, as you talk about, what are you looking at in terms of the components, the underlyings of some of the employment cost index or what we get with payrolls on Friday to get a sense of how sticky this disinflation is?
Yeah, I think all of those plus the CPI data are first order important, especially for the Fed. So we've actually got a house view that's a little bit dovish relative to markets. Like everybody, we expect 25 basis points at this meeting, but after that, we think they're going to be done at the Fed. The only way that happens, but we think it is the path that will happen, is if we get non-farm payrolls coming down well below 200 and looking like they're going to 100,000 and in fact below 100,000.
Seth, I think we described now is not in the textbooks. We're coming out of all the pandemic and supply side dynamics, and maybe we're getting back to a more traditional monetary analysis. And around that is not the question, is Jerome Powell central banker to the world, but more nuanced is, in what way is the chairman of the Federal Reserve central banker to the world?
Yeah, I mean, a few things. It's clear that what the Fed does matters, and it matters a lot for the global economy. Interestingly enough, this cycle was a little bit different in a number of ways. If you think about some of the EM economies, especially in Latin America, we saw, for example, this Brazilian central bank start to raise rates in anticipation of the Fed's hiking cycle. They got out a little bit in front of it. Some of the other EM central banks have been similarly defensive, and so there's actually been a little bit less of a negative spillover to other economies than you might have expected in some preceding cycles. But there's no two ways about it. We saw the yen for a while depreciate really aggressively. We saw the euro depreciate very aggressively. What the Fed does has critical importance for the rest of the world.
So let's talk about what you expect the Fed to do. You said that you could see jobs go down to, say, sub 100,000 in the next couple of months, allowing the Fed to pause with the rate hikes. What are you seeing in the fundamentals, in the corporate earnings, to give you a sense that we are going to see that massive and sudden drop-off in job creation?
Excellent question. And first, I want to preface it that even though we think this week's Fed meeting is going to be the last rate hike, I don't see any way at all that Chair Powell and colleagues are going to indicate that it would be the last hike. In fact, I suspect they believe it will not be the last hike, and it's going to take the data coming in as soft as we think that they will before the committee actually starts to change its mind. So the rhetoric, I think, stays on the hawkish side, which I think is similar to what Mike had said just before the segment. So then what else is going on? Again, I don't think the slowdown that we're calling for in non-farm payrolls is all that dramatic. The last print was 230 or so. It's been this consistent decline in non-farm payrolls that we think continues and gets down to a really soft run rate. Chair Powell keeps talking about wanting the economy to grow below potential for a while, and that's what we think it takes.
Seth, thank you so much. Seth Carpenter is with Morgan Stanley. Markets lift on the ECI news. They come back down to red on the screen and now relift up to new highs for the day. Futures up 7, Dow futures up 47. Lisa, I want to sell forward to Thursday. And Robert Schiffman, who's fabulous at Bloomberg Intelligence, on the debt side and the cash flow side of these tech juggernauts. I mean, his headlines are simple. He says, look, their cash flows are resilient. I love this headline. Microsoft to lose AAA rating, time for a $50 billion bond issue. Amazon's financial trouble, firing thousands, borrowing billions. Tech bonds going wild. I love that. Apple's $1 trillion milestone. Shareholder returns keep growing. Schiffman, from a bond purview, screaming tech optimism.
From a cash flow perspective, these are juggernauts, as you said. These companies are minting cash. The question really is the valuation. Have the valuations gotten ahead of themselves during a free money era, during the pandemic? And really what I'm noticing, based on the fact that you're basically seeing flat trading on Apple and Amazon after the ECI report, how interest rate sensitive these names still are. Interest rates lower, tech names higher. That has been the theme, and it continues to be because of valuations.
I mean, if you generate the number's so big I can't say it, $100 billion in free cash flow, that is a conundrum. I mean, that's something to worry about.
Which country are you going to buy?
I don't know, maybe buy the Boston Red Sox and fix things. That was Apple's free cash flow. Stay with us. A lift to the market off ECI. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve officials are on track to consider pausing interest rate hikes after next month's meeting. That's if there's more evidence that inflation is cooling. The scenario is based on a timeline sketched out by one of the Fed's most closely watched hawks, Christopher Waller. Policymakers are expected to raise rates by a quarter point at the end of a 2-day meeting on Wednesday. The White House will end a pair of COVID emergency declarations on May 11th, and that will mean the end of the controversial Title 42, a policy that expanded expulsion powers at the border of the U.S. and Mexico. The emergency declaration also allowed millions of Americans special access to Medicaid, the program that provides health care to low-income people. General Motors expects its earnings momentum to grow this year. The automaker reported better than expected profit in the fourth quarter. GM is counting on continued demand for its highest profit margin SUVs and trucks. It's also expected higher production levels as supply chain issues fade. United Parcel Service forecasts sales below Wall Street's estimates. Now the package courier is struggling with a drop in volume as shoppers return to stores. Meanwhile, inflation is cutting into spending habits. And Boeing will deliver its final 747 today. A cargo version of the jumbo jet will be turned over to Atlas Air. Over 5 decades, more than 1,500 747s were built. The plane would carry more than 500 passengers, and it's Boeing words, it shrank the world and democratized air travel. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
As growth forecasts are increasing and inflation is falling, will the European Central Bank make its 5th rate hike in a row? How high do rates need to go? Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
The central banks, and certainly the ECB is pushing this line, have got much more wood to chop. They've got much further to go.
Coverage begins Thursday, only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
To what extent are these big technology companies laying off employees but still outperforming against expectations? So I think that these layoffs put these companies in a position where it's more difficult for them to show better than expected sales and profits. Because if they had better than expected sales and profits, why are they cutting headcount so significantly?
Tom Forty with D.A. Davidson there on the tech path forward here. Lisa, just quickly looking at the markets, a lift off what we saw with ECI futures up 9.
Basically, if you have less inflation pressure than expected, you have a lift to markets, bond yields lower, stocks up, and that is the story so far of 2023.
Right now, we're going to dive into the streaming era. It's always fun to do this with Paul Sweeney on Bloomberg Radio as well. Brian Weiser joins us now, principal at Madison and Wall. His great work with WPP over the recent years as well. And what's so unique about Brian Weiser is he has been a great supporter of television and traditional media and traditional advertising. It was everybody else says it's going to blow up. And yet you said before we went on air, maybe now's the time where there's some real challenges.
Yeah, I mean, Bob Iger said it well before he went back to Disney. TV is at a precipice now, and there's a real problem because we're 2 years away from less than half of the country having pay TV.
Yeah.
Less than 50% pay TV penetration in 2 years. It'll make it almost impossible for traditional advertisers to meet their goals through television. That's a new thing. That wasn't true a few years ago.
And I failed, folks. I said, I think 10 days ago, I was going to watch Wednesday just to keep up with the zeitgeist, but I haven't gotten there yet. Are you watching at home?
No, I'm waiting till tomorrow. So, but ching. All right, go on.
Wednesday as well. But the fact of the matter is, Jon Favreau invented this wonderful Mandalorian, and I'm sorry, Disney Plus needs Mandalorian to win. Is that all this has come down to? Is you got to have hits?
All the investment that's going into the streaming services will produce more hits, and most of it will not be ad supported. Fundamentally, most people will still choose the ad-free options for most of these services.
So we get Meta tomorrow, we get Alphabet or Google coming out on Thursday, Disney coming out the following week. What are you looking for? What's going to be the theme of this particular media reporting season?
I think the gap between the narratives that we'll see versus the reality will be the main thing I'll be looking for. By that I mean, we're going to see a lot of negativity in the numbers because you're going to see a Meta that'll have soft, maybe negative numbers. Google will probably be negative as reported, but people are going to forget about the currency effects because that's going to be a 5 to 10% headwind depending on the company. Underlying advertising growth will probably end the year 2022 in a pretty positive position. You saw Spotify this morning, 14% as reported growth in euros, 4% in constant currency. 4% is a more realistic number to think about, but we've got to be conscious of the currency effects and how that's going to impact the narratives.
So let's put some numbers to the currency impacts. This one agency, Kyriba, came out and said that North American companies lost about $43 billion from July to September, an all-time high due to the currency fluctuations. So to your point, this is a big headwind that might be turning into a tailwind this year, considering what we've already seen.
It'll change the narrative because here we are in an economy that's actually growing, despite, I think, a lot of expectations of more negativity. You see the Europe numbers today, we saw the U.S. numbers before, and the reality is that underlying economic growth is still happening. Inflation is additive. Inflation actually adds to advertising growth, right? And so you're going to see a mid-single-digit advertising market, not negative numbers. And so there's going to be a gap between the headlines, which are going to be as reported in USD, which could be negative, but constant currency will actually be positive.
I usually don't do this because I just don't spend time on Meta, Facebook, whatever you want to call it. But you are the genius on this. You and Kudrowski and Kirkpatrick and the rest of them, you three were way out front on the challenges and then the huge success of what Zuckerberg did. Does he need a new CEO? And is that going to be the surprise here to get Facebook to launch up 60% to get back to its 2021 high?
That's a good question. I mean, the reality is that Zuckerberg is the CEO. Will he change his orientation around the metaverse? I mean, that's probably one of the bigger issues because if they want to grow their advertising business, they're going to have to find ways to invest into new areas. They're so big inside of digital advertising, there's not a lot of room for growth. Can they invest into different spaces if they want advertising growth? That is the thing they have to do. I think you have to decide on that strategy before you choose a different CEO. If they think that the metaverse, as they've characterized it, is the right place, Zuckerberg might be the right person.
He's the only one I know, Lisa, that could say metaverse and I don't break out in smiles. Are you kidding me?
I'm not.
What in God's name is the metaverse?
Well, to be clear, I don't think that it's a place I would be investing in right now. I mean, if you're talking about $10 billion a year, for however many years to produce uncertain outcomes. But if you believe that the CEO has a clear view about what exactly it is,
what is the metaverse? You're the genius on this.
I don't know. It involves legless avatars floating around.
You and Kirkpatrick are sitting here at a table, and we're having a navel-gazing interview over the metaverse. Come on, Brian, what is it?
I don't know.
Thank you.
All I'm saying is, if you believe that the CEO has a vision for what exactly it is, you're betting on that CEO. So what you say, should he change CEOs? I'm saying, I don't think anyone else would have the same vision he does. He might be wrong, but no one else is going to execute as well as he would.
So, Tom, you will come over someday, and my offspring will explain to you the metaverse because they are well-versed in the metaverse, and they understand potentially why it makes sense to have currency.
Right?
And, well, it's Roblox. It's a whole ecosystem that is in the ether, sort of in the cyber world, in the cybersphere, but then there are actual, tangible, real-world things that can transact. Look, I've got kids. This is what happens.
Apple may very well get there faster first with something more realistic.
Correct.
Right? Because of whatever VR, AR, evolutions we get, they'll probably drive it in a more palatable way. Snap as well. When Snap reports earnings today, keep an eye out for whatever they say about all their work in AR is actually an early stage version of where this goes.
Are beginning to a bionic future. Just discussing the macro picture, I am curious about the interest rate sensitivity of this sector, because what you're talking about, we are still seeing single-digit growth. It isn't Armageddon by any means, but the valuations are pricing in really rapid growth on free money for a long time. That's what it was. So at what point do the earnings not matter? Does it really hinge on the macro picture?
Yeah, I mean, here's the thing. Interest rates now are about where they were, through most of the 90s, which was a pretty good era, as far as I recall, for advertising and for media, generally speaking. You can have mid-single-digit levels of cost of capital and still have a growing industry. I think you end up killing the frothy things, the rapid delivery businesses. I came up with all these crazy ideas for what I would do with $1 billion of free money on our podcast I was publishing previously. And I mean, the point is that that's not realistic.
20 seconds. What does WBD do enjoying 65.7% debt?
I mean, here's the thing. They are starting to sell themselves off for parts. You saw the selling of the music part of the movie studio. They'll probably find other pieces to sell off to pay that down as much as they can.
Brian, thank you.
Thank you so much.
Superb.
Thanks very much.
Madison and Wall's. Are you going to do
Madison and Wall? Madison and Wall.
Are you going to do buy, hold, sell with Madison Wall?
No, Madison and Wall is a consultancy, strategic consultancy to companies, financial institutions, and others.
Okay, very good. Brian Weezer with us here on streaming and the rest of it. You impressed the hell out of me there with the metaverse. Is that the thing
I have these
where
debates.
You do this thing?
That's virtual reality, but the metaverse.
Do you do that at home?
No, I don't. I mean, maybe my existence is that. We can discuss that. I really doubt that. That's just not true.
Oh.
Yeah. Can you do that one more time?
Pharaoh's looking, oh my God, 18 goals in January.
You know, this is the discussion among a lot of, people who are younger. If you look at Snapchat even, you can see your friends' avatars in different places, right? And so you can go meet them where they're at, which is basically a meetup app for people in a certain network. So what's to say you couldn't meet up in a sort of virtual way and on the ground way? I mean, these are all the discussions that are going on.
It's going to have to say.
You're like, not in my household.
I'm a fossil on this. I won't let the games in the house, the Sony stuff and.
It's not on Sony stuff. It's not on those things. It's all on the phone. So they're probably doing it anyway. Yeah, no, unless you have a much better handle on it.
Can we talk about a market lift here into the 9 o'clock hour? It's a nice market lift, a 10-year yield in 4 basis points, and futures up 12 as a lift here. We're at 4,043 SPX, 33,800 in the Dow. I'm sorry, it's a move.
If you just are joining, the employment cost index coming in at 1% of a gain year over year in the fourth quarter versus the 1.1% expectation. Yeah. So just moderately softer than people had expected, and that's what's really driving the gain.
I'll ask you, did we all get along today and sing Kumbaya so we can do this tomorrow? It's the first time we've been back together since time began.
I think we might have managed to muddle through.
Early. We left it off.
It's nice to have you back.
Yeah, Brian, thank you for me back. I thought you meant Brian Weezer.
I was actually talking to you, but Brian, it's nice to have you here as well.
Tear up here as well.
Yeah, exactly.
An important conversation as he spoke to the Chief Financial Officer of Generous Motors, David Calhoun.
I was actually talking to you, but Brian, it's nice to have you here as well.
Tear up here as well.
Yeah, exactly.
An important conversation as he spoke to the Chief Financial Officer of Generous Motors, David Calhoun. Much to talk about. He is the Boeing Chief Executive Officer. Look for that this afternoon. Stay with us on radio and television. This is Bloomberg Surveillance. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, of the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
Here they're going to have a short and shallow recession, plain vanilla, garden variety. It's totally delusional. It's totally delusional because we're not going to have only inflation. We're not going to have only stagflation. We'll have a stagflationary debt crisis, the worst of the 70s and the worst of the post-GFC period. That's what's going to happen.
I got to say, you're not helping with my anxiety levels right now.
I'm going to go. I'm moving my portfolio to cash. 1 second. I got to pause the podcast.
Well, cash is not enough because it's wiped out by inflation. You have to go to assets, and I can discuss they can hedge against inflation.
Stagflation already seems like the nightmare scenario for central banks if you have high prices and lower growth. But if you tack onto that a debt crisis plus stagflation, that just seems like incredibly difficult for any central bank to navigate.
Live from New York City this morning. Good morning, good morning. The employment cost index in America coming in a little bit softer than expected. Yields push lower, equities push a little bit higher. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, the IMF sees a turning point for the global economy as China's economic activity rebounds sharply. The Fed's two-day meeting commences in Washington. We begin with the big issue, closing out a big month of gains.
Huge rallies to start the year.
Hallmarkings of a January effect.
Some real optimism airing in.
Events that didn't play out, essentially.
Overall, the hard data is looking good.
Frankly, that data just hasn't been negative enough to justify the low positioning.
January, we saw a boom in primary issuance in the capital markets.
We do worry that the market's got a little bit ahead of itself.
Those are all signs that the Fed doesn't like to see when they're trying to contain economic activity.
The market is trying to call the Fed's bluff.
Powell is very likely to remind the market that the Fed's plan is to stay hawkish.
Chair Powell is going to push back aggressively around this bullish narrative.
Can't imagine that, with the Fed particularly, that Powell loves to see everything flying higher.
I would expect that he would push back against these financial conditions. Those animal spirits are not what the Fed wants to be encouraging.
Joining us now to discuss this principle is Seema Shah and JP Morgan's Tom Kennedy. Seema, first to you. I'm going to use your words. Here's the quote. After reaching a peak rate of 525 to 550 in the first half of the year, Fed policy will have to remain restrictive throughout 23, even as the U.S. economy falls into recession. So, Seema, can you tell me what separates you and this Fed away from this market pricing interest rate cuts this year?
Yeah, it's been an interesting one. I think what the market is still holding on to is that recession will be enough to convince the Fed to come in and provide that relief. But what we've seen historically is that, look, inflation comes down very, very slowly. We've heard from Powell time and time again that they're very concerned about that historical narrative. and they're very, very concerned, want to learn from their mistakes in the 70s. So what we're saying is that, yes, inflation is going to come down. It's going to come down towards 3%, but it's also going to be accompanied by economic weakness, and that is not going to be enough to convince the Fed until you get into early 2024 when they have clear evidence that inflation isn't going to resurge.
Tom Kennedy, are you with SEMA or are you with this market?
No, I think the Fed will be cutting this year. You're well along the path for the desired outcomes from the Fed. The housing market in America, residential housing, is in a recession already. Margin compression has started. The next phase will be defending those margins for corporate America. That most likely means layoffs. At this point, John, I think you're at the place where layoffs are the most likely catalyst to give Fed confidence inflation will get back to 2%.
Tom, this is a process, as you know. Why do you only expect those layoffs, though, in the second half? You're not expecting them anytime soon, based on what I've read from your research. So can you tell me why you do expect them in the second half?
Yeah, I think first you're going to see, John, is that CapEx intentions will continue to get cut. We're getting clear indication that's happening here. The layoff piece is usually the last thing to go. We're all getting very impatient in this business cycle. Things are seemingly happening very fast, but for economics and regular folks in America, it tends to take a little bit longer. The tech sector is there, John. I think it's the next sectors to really look for: construction, manufacturing. Those are the types of places where layoffs are most likely next.
So, Tom, Standard Chartered and Steve England put this out in the last couple of days. They said the incoming data would be soft enough for the Fed to pause in March. However, this week, the FOMC and Fed Chair Jay Powell will likely signal that there is not yet a conclusive case for a March pause. Now, I know this is really difficult to do, Tom, but if you can get to March 22nd, can you tell me where you think we will be? Because right now, claims at sub 190, claims are pretty down low.
Yeah. John, I really don't know. I think you're going to get to a place where your 50-50 and optionality is their friend. I think that's what Powell's message should be this week. We're slowing the pace, but optionality is our friend. And until we get our desired outcomes, which is a cooling in the labor market, it's unlikely that we will be able to ease conditions meaningfully.
Sima, what's interesting about this is that you don't exactly disagree when it comes to the economy.
Yeah.
You're looking for that economic weakness. You just don't believe they respond to it in the way that you think, the way that Tom thinks they will. Why is that?
Yeah, it's interesting. As Tom was saying, I actually in agreement in so many things. We are expecting economic weakness to come through in the second half. We are expecting job losses. We are expecting the unemployment rate to increase, and we are concerned about housing. Our concern is simply just that the Fed is worried. They've learned their lesson, and they don't want to be the Fed that makes mistake twice, letting inflation take off and then letting inflation take off again. So we think that they're going to stay pretty firm, even as the economic weakness starts to show through and real people start to struggle a little bit. We think that relief comes in 2024, but 2023 is about staying firm.
That's going to be a big conversation for us around the news conference as well with Chairman Powell. 25 minutes away from the opening bell. Equity futures are a little bit positive, up a third of 1% on the S&P. Yields come in just a little bit as well on the 2-year by 4 basis points to about 420. Mike McKee alongside me. Mike, you just responded to the data we had about 35 minutes ago. Run us through it.
Well, it was pretty good news overall. The employment cost index coming in lower than it had been, and service industry wages lower than they had been. So that was pretty good news. Here's a chart that explains the debate you guys are having right now and what Jay Powell has to do tomorrow. This is a historical through the last year and a half of the Fed and its dot plot and what the market thinks, which is your red line there. The market thinks the Fed is off its rocker at this point. Over the last 6 months, they've decided the Fed is going to have to cut rates and go down. And so you can see that in the dot plot. Now, what do they do about it? According to the latest Bloomberg WIRP, in terms of what the Fed's policy is going to be, they're going to get to June, they're going to get to 5%, which is 2 more 25 basis point moves, one this week, and then they're going to start cutting rates. And we get down to basically about a 25 basis point move lower by November. So the market needs some convincing from Jay Powell. Maybe the ECI, as you mentioned, does give us some reason for hope that inflation is going to come down faster. They've been worried about wages. This is the indicator that they like to follow because it is more comprehensive than others. And you can see ECI is much lower and coming down at a faster pace, perhaps, than average hourly earnings and certainly than PCE. But if it pulls down those two things, then that's going to be good news for the Fed and reassure them a little bit that they can back off from 50 basis points down to 25.
Mike, you and I have talked about this a lot. I think we know the question that will get asked in this news conference. Either you will ask it or one of your colleagues will. The question is, the unwarranted easing of financial conditions. Is it unwarranted? Is it warranted? Mike, when he's asked about financial conditions easing, how do you think he's going to navigate it?
Well, I think he's going to say it's not particularly helpful, but the Fed is seeing the economy slow, even though we're seeing financial conditions get looser. And so he can't make the markets behave, but he's going to try to keep them from making things any looser by reacting immediately and start pricing in rate cuts.
And Mike McKee, looking forward to your coverage tomorrow. Mike McKee there on the Federal Reserve. This came from Marko Kolanovic and the team over at JP Morgan in the last 12 hours or so, 24 hours. We believe investors should fade the year-to-date rally as recession risks are merely postponed rather than diminished. Postponed rather than diminished. Now, Seema, can I come to you on this? I think this is important. If you think that the recession is just delayed and not avoided, is that a tradable event? Is that something you want to buy or something you want to fade? What do you want to do in between? Because right now, over the last month, this market's really rallied and quite hard.
It hasn't. This is the time to fade it. I mean, look, if the market is pricing in 75 basis point worth of cuts, it is expecting a recession. So for equities to be performing so well when it's actually anticipating a deeper recession, seems to me that this is something that we should really fade. The fact that the market is rallying today is because it's looking simply at the fact that the Fed is near the end. It's closer to the end than it is to the beginning of its hiking cycle. And you're yet to see the economic pressures really break through to the surface. But if you look underneath, you can see that the cracks are forming. So I agree, this is a little bit delayed. This is looking at the second half of the year. It's not imminent, but certainly it's not going to be avoided.
Tom, you agree on rate cuts, or rather you disagree on rate cuts. Do you agree on the price action? Do you agree on the market call?
I think the market price action is somewhat as expected. ECI is confirming that average hourly earnings have been telling us for a few months, in a 3 or 6 month annualized basis, wages have slowed. Mike McKee said it beautifully. This is a really positive outcome, and it cuts off the likelihood that the Fed will have to hike to 6% as an example. The market should price that. They should adjust. And the Fed is telling you they're likely to keep rates around 5% for the whole year because that's the most likely outcome. It's a modal outcome. But we as investors, we don't price modal outcomes. We price the possibility of things that could happen. And the point is really important. It's more likely than not they'll be cutting. So we have to see interest rates in the future come down. Now, risk assets, John, to come back to your central point here, risk assets will have this exuberance phase through it. I think we're there. You're pricing just markets, multiples in excess of 5, 10, 15-year averages against earnings that are too high. That doesn't mean there's not opportunities, though. Where can we find value? Things that are relatively cheap. Places like small mid-cap in the U.S. Europe is now looking pricing the same way.
We're going to talk about Europe in just a moment. Can you talk to me about credit, just briefly, Tom? Sub 50 ISM, the Fed hasn't cut yet. We've already had the rally. Spreads are tighter over the last few months. What do you make of the move?
I think spreads there are too tight. I think for an investor in America that is a high taxpayer, subordinated bank capital is a better relative value opportunity set. High yield spreads are tight, potentially because the yield is just so attractive, near almost 10%, and it's trading more like a yield product. We haven't seen anything like that in America in 25 years, but relative value, I don't see much value there.
Massive focus on fixed income coming into 2023. Tom Kennedy, Seema Shah sticking with us this morning. Yields lower. Treasuries rallying. Your 2-year down 4 basis points. Sub 420 now on a 2-year. On a 10-year down 5 basis points to about 349. Coming up, the global outlook gets an upgrade.
What we are looking at is what effectively is going to be still a challenging year. But still, it's an upgrade compared to what we were expecting back in October. And this is due to resilience, resilience, resilience.
Resilience, resilience, resilience. That conversation up next.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
What we are looking at is what effectively is going to be still a challenging year, but still it's an upgrade compared to what we were expecting back in October, and this is due to resilience. We've had more resilient households in the U.S., resilience to the energy crisis in Europe. Labor markets have been very, very tight. And then in addition to all this, you have the reopening of the Chinese economy that is promising to give a boost to global activity.
The IMF seeing a turning point for the global economy, raising its economic growth forecast for the first time in a year as the Eurozone unexpectedly expands in the fourth quarter and activity in China rebounds sharply as the economy reopens. Bloomberg's Tom Orlik joins us now in Washington. Tom, good morning to you. Can you run me through just how big a bang, a boom you expect in the Chinese economy this year?
So China reopened much quicker than expected at the end of 2022, Jonathan. The immediate impact of that was a big slump in activity. China's 1.4 billion people understandably decided they didn't want to get sick and they stayed home. What the PMI data for January is telling us is that that hiatus in Chinese activity has been over pretty quickly. Manufacturing, services, both bouncing back strongly, services certainly roaring back into pretty strong growth. Now, Bloomberg Economics has an above consensus call on China's GDP this year. We're looking at a 5.8% expansion versus 5.1, which is the consensus view. This early data from January certainly points towards a pretty strong year for Chinese growth.
Tom, you and the team have written about this in the past day. In fact, I think it published this morning. Tom, can you walk me through how you think the story of the economy reopens relates to a story of Europe and the rest of the world importing inflation from China? How do you think that's going to develop this year?
So there's two pieces to it, Jonathan. The first is a welcome boost to global demand. Let's not forget that Europe is starting the year, if not in recession, then at least extremely weak. And most, including us, think the US is heading into recession at the end of the year. So China reopening is going to give a pretty welcome bump to the global economy. We think it adds about $500 billion to demand, the equivalent of adding an entire Nigeria to the global economy. The flip side of that, of course, is that stronger demand risks reigniting inflationary pressure. We've looked at some numbers, we've put them into a model which relates China's growth to global energy prices and CPI in the US, Europe, and the UK. And we think that China reopening could be worth about 0.7 percentage points on the US CPI at the end of the year. Not massive in the context of a US CPI which was as high as 9% pretty recently, but still enough, if it plays out that way, to derail expectations of a Fed pause in the second quarter.
Hey, Tom, that's a really important final point. Tom Orlick there at Bloomberg Economics. Thank you. Back with us, Seema Shah, Tom Kennedy. Tom, how do you think about this issue? Do you see the positive, a better growth profile, or do you see the negative, the potential that we get a disruption, a more inflationary impulse from China reopening?
I think we're mostly thinking it's a positive for the global growth story. The reason to fade a little bit of the optimism there is twofold. Number one is many are mapping the reopening that we've seen in the Western world to what we'll see in China. Yes, consumption will surge, but the excess savings and ability to lever up is not the same in China. We're closer to consensus on growth in China this year than what Tom just described for Bloomberg Economics. From an inflationary impulse, though, the vast majority of China's impulse for the last 10 years has been through the property sector, and that is a sector that is still languishing. So for the most part, we're focusing on the growth impulse rather than inflation.
Seema, what about you?
Look, I think we're focusing on the growth impulse, and we see that there is certainly international opportunities, and China, emerging markets is a key part of that discussion. I think on the inflation side, it's a concern, it's a risk, that when you think that the market is pricing in almost a straight line down, this is something that would cause a fairly meaningful surprise. And if I just do back of the envelope calculations, if you expect core goods inflation in the US just to normalize to post-GFC levels, it gets you core CPI down to 3%. But any kind of upside surprise to that, and you're above 3%, and that's not a level that the Fed is going to be comfortable with. So I don't think, we are focusing on the growth side, but that inflation risk, I think, has to be taken into consideration.
So that risk on the horizon, let's see how that develops. In the meantime, Seema, everyone asking the same question. How do you play the China reopening story? My question would be, what hasn't participated already over the last 3 months? Where do you find those opportunities?
That's a good question. It's one that we're getting all the time. Is it all done now? What we're saying is that, look, maybe not look at China because there already has been such a significant move. Maybe let's start thinking about places like Latin America where they will feel at least some of the sun rays from China, but also their valuations are still extremely cheap, and actually it's offsetting some of the political concerns in places such as Brazil. So Mexico, Brazil, Chile with commodity price moves, that's probably an area to focus on, as well as parts of emerging Asia, Vietnam, Thailand, who have also very attractive valuations and still that growth prop up to come.
Chinese tech's ripped over the last 3 months. The miners have ripped over the last 3 months. You've seen Caterpillar rally really hard over the last 3 months. The Euro Stoxx 50 in the last 4 weeks is up by more than 9%. Question is, Tom, for you and many other people, what's left to play for here?
Yeah, we're doing the same thing you are, Jonathan. They're trying to find places where there is value. China has rallied very quickly. There is still value there because earnings are inflecting higher, the only major economy in the world where that's happening. But I think for our clients where they're still underexposed to Europe, that's a better position to be in. Number one, it's still relatively cheap to its own history. Number two, there's still a significant discount to the US stocks, which our clients tend to hold a lot in. And we just got two big surprises. A warmer winter and the China reopening, which should benefit the luxury and travel sector in Europe. I think that's got to be our focal point for the next 3 to 6 months.
Tom, when you speak to clients and you push that story, my question is often this one. How receptive are they to that story, given they've heard it so many times over the last 5 years?
I think it's a struggle, John. I'm going to be honest. They've been burned many times, but when you're trying to show them that a lot of the world is expensive, and this is a place that's relatively inexpensive, and it offers them an opportunity to, in addition to the point I made, diversify their FX globally, I think we're going to get some good reception on this.
And Tom, other people would just say we're one rate cut away, a rate cut that you expect later this year. From tech leadership reasserting itself, we've seen that over the last month, and the US leading again. Do you also believe that we will get this change in leadership, not just in terms of the kind of companies that rally, but where those companies are based? Do you get that new leadership? Is this truly a new regime?
Yeah, I think it's going to be a new leadership from equity cohorts and where CapEx follows. It's very common to see leadership change. I mean, that's stating history as on the side of this call. But all the names, the big mega cap tech names that we've all owned for the last decade are seeing earnings growth slow. Their business models have matured. Is it possible that they are returning capital to you and I, John, because they just don't have the same type of investment opportunities from M&A, CapEx that they once had? I think it's very possible. And from a CapEx orientation perspective, that was leadership last cycle. I think leadership in the next cycle is going to be more real economy based, and that favors Europe and other sectors of the US economy.
Tom, in the meantime, just to jump in, you've talked about where we are in this process, in the cycle. We are at that point, as you've stated, where companies are starting to defend margins, cut costs, and we're seeing that with big tech. Is that not enough for you?
No, I don't think it is. I think from an investment perspective, everything I'm about to say leads to bonds. And bonds have rallied a lot. If we do get this recession that Seema and I have talked about, rates need to come down more. The desired effects are there, and it's proof that these are restrictive rates. But what's really, I think, has to be enough, ECI is proving the worst case scenario of entrenched inflation is gone. But now we have a level discussion, and it's pretty clear whether you look at ECI, average hourly earnings, or low, medium, high income earners in America. They're all seeing wages around 4.5%, and it's too high. We need to see the labor market weakness to feel confident.
Seema, I've got 30 seconds on the clock. You get a final word.
Yeah, look, I agree. Look, I think tech is going to continue to be challenged. Yes, yields are going to come down, Fed, but I don't think that's going to be enough. I think it's too early to talk about growth value at this stage, but once you get into 2024, and we're expecting inflation not to return to the sub 2% levels that we've had over the past decade. So that is a time for resurgence in value. And what does that point to? It points to Europe.
Hey, Seema, great to catch up. Seema Shah there alongside Tom Kennedy, pointing to Europe. Equities right now in the United States, pointing to the US, pointing lower. Rolling off session highs, we're now just about positive by 0.1% or so. Coming up, the morning calls, and later, Crossmark's Victoria Fernandez sticking with staples and cyclicals amid continued macro uncertainty, looking for some balance around the opening bell. The opening bell, 7 minutes away.
Person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Away from the opening bell, equities still just about positive on the S&P 500, up a little more than 0.1% off the back of that softer than expected employment cost index here in America going into that Fed decision tomorrow. That's the price action. Let's get you some morning calls. First up, CFRA downgrading Baidu to sell, 103 price target, expecting regulatory headwinds to remain a consistent overhang. That's stuck negative by 1.4%. Macquarie downgrading Paramount to underperform, highlighting the company's outside ad exposure and a stock's rich valuation. And finally, Atlantic Equities downgrading B of A to neutral, warning that banks typically underperform heading into a recession, down about 0.1% on that name. Coming up, expecting high yields to fuel volatility. That's the view from Crossmark's Victoria Fernandez. That conversation just around the corner. Your opening bell up next.
very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Names in global leadership are on Bloomberg.
I very much support the idea of a stronger sovereign geopolitical European Union. Democracies should cooperate and that they should understand that there is something we have in common, respect for the individual rights of men, being in favor of the rule of law.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
Seconds away from the opening bell this morning. Good morning to you. Equity futures are just about positive by 1/10%. The sentiment improves a little bit off the back of the ECI, the employment cost index for the fourth quarter here in America. That comes in a little bit softer than anticipated. Equities get a lift going into the open. There's the opening bell, switch of the board into the bond market, and yields drop a little bit lower off the back of that too, down 4 basis points. On a 10-year, we break 350. 349.58 on a 10-year yield in the FX market, euro dollar 108.60. After the Fed, you go to the ECB. The Federal Reserve expected to go 25 basis points tomorrow. The ECB expected to go 50 basis points on Thursday. Let's round things out with a look at crude. We're down about 0.6% on WTI, $77 and around about 40 cents. 20 seconds into this one, equities just about positive by 1/10% on the S&P. On the Nasdaq, up 0.1% also. One stock to watch at the open, Caterpillar, posting its first quarterly miss since the start of the pandemic as it grapples with rising raw material prices. For more, let's get to Abby. Hey, Abby.
Hey, John. Well, this one is interesting because not so long ago, just moments ago, it had been down just about 0.3%. So really all over the map, holding that loss that it had earlier in the pre-market after posting this first loss since 2020. It's not all bad, though. They also put up pretty solid revenues. They beat revenues, in fact. So it's really the profit miss, not being able to manage those margins for the first time on rising manufacturing costs. They also have a goodwill impairment charge tied to its locomotive business. In fact, we have some headlines coming out recently, and the CAT CFO saying that the material and freight costs increased 20% since 2020. So until now, this company has done a very, very good job of managing those costs, and the earnings miss, it's less than 3%. So it's going to be interesting to see if this stock holds on to its loss. Right now, it certainly is down 2.5%. As for some of the good news, because, John, this is really interesting, and this is a surprise to me. Just last Friday, this stock at an all-time high. How many stocks can you say that about? It has something to do with this picture right here, that demand, record backlog, quarter after quarter, close to $30 billion worth of demand. So again, it's going to be interesting to see whether or not the 2.5% loss hangs out for the day, or if investors propel the stock higher on what are really mixed results, but the underlying demand is good. It's just a matter of managing those margins.
Down about 3%, 2 minutes in. Abby, thank you for that. Big international story here. Caterpillar bottomed the same day the dollar peaked at the end of September 27th. And since then, Caterpillar has rallied by about 56%. That's accounting even for this move lower this morning. So, bit of context over the last 3 months for you. Caterpillar down about 3.3%. In fact, make that the last 4 months now. Earnings also coming from the energy sector. Exxon holding back on announcing any new buyback plans despite posting a record profit of $59 billion. Kaylee on top of this one. Hey, Kaylee.
Hey, John, it's absolutely unreal, the numbers we are talking about for the full year. And for the fourth quarter as well, Exxon beat expectations, their 9th beat on EPS in 10 quarters. Contrast that with Chevron that actually missed in its fourth quarter report last week, but again, also reported a record for the year. So these two companies together, these oil majors, have pulled in nearly $100 billion in profit over the course of 2022. But another contrast, as you alluded to, is Chevron last week announced it was upping its buyback program to $75 billion. Exxon, though, did not raise its plan. They left both the buyouts, the buybacks, and the dividend payment as is. They're planning $35 billion in repurchases for 2023, but that is after expanding buybacks multiple times last year, and the company has signaled its intention to repurchase $50 billion of stock through 2024. Interesting to note as well, in 2022, Exxon returned about $30 billion to shareholders. Global capital spending, meanwhile, was only $22.7 billion. So this is a major reversal from much of the last decade when CapEx was higher than those shareholder payouts. And that could add more fuel to the political fire as the Biden administration really wants these guys to be pumping more oil, bring supply up to put prices down. And Darren Woods, the CEO, actually addressing supply on the conference call just now, saying that the oil industry is underinvesting in new production. He sees the potential for continued tight global oil markets as some producers pull back. And in theory, John, that could mean upside to oil prices.
Looking for the White House commentary on that, maybe a little bit later. Looking forward to that. Kaylee Lights, thank you. About 4 minutes in, we are positive by 0.2 on the S&P and the Nasdaq up by 0.4%. Snap reporting after the closing bell as it heads for its best month of gains since 2021. Investors expecting results to shed some light on the state of advertising. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, that's the thing. Snap matters because it's one of our first looks at what online ad demand looked like in the fourth quarter. We know that's been a sore spot for the industry at large and for Snap in particular. If you look at shares over the past year, I know they're up so far this year, but train your eyes on these red circles. As you can see, its last two earnings reports sparked sell-offs, and you can't forget when it cut its forecast in May. That's when the pain really started for this company. So that's Snap. That's after the bell today. But we also have EA and Spotify to look forward to today, and then we get to the real heavy hitters. I'm talking about Meta, Peloton, Alphabet, Amazon. And if we think about what's going to be the topic of conversation, it's probably going to be cost cutting, layoffs, and margins, all going to be in focus as the pandemic era boom fades for a lot of these companies. And John, the stakes are high when you think about the big tech resurgence that we've seen so far to start 2023. The Nasdaq 100 at this moment, it's up about 9% so far for the month. That's the best January since about 2019. So we could be setting up for a big reality check as these earnings roll in. And you can't forget the Fed tomorrow.
What a run. Katie, thank you. Year to date, to Katie's point, you've got to talk about it over the last 12 months plus, but year to date, Snap up by 25%, Meta up by 24.4%. Worth pointing out that when it comes to Snap, just look at the price action over the last quarterly reports we've had. On October 20th, the stock was down 28%. In the quarter before that, the stock was down 39%. That's 1 day price action after the results. So that probably gives you a decent idea of some of the moves you can expect in a name like that one. Social media stocks having a great start to 23 after a major down year. Citi's Kristen Bidley telling investors to stay cautious on the rally.
I don't like this rally. Going into the end of last year, you had a lot of tax loss harvesting. You also had the most bearish positioning that we've seen since the global financial crisis. And when you look at what's driving this rally, it's all of the laggards and losers from last year. And so this is more of a technical rally. It's not something that has fundamentally changed.
Crossmark's Victoria Fernandez echoing that view and looking ahead to Chairman Powell writing the following. We still aren't completely convinced that there is an all-clear signal for a sustainable rally. There is quite a bit of macro uncertainty, but at the same time, we have companies saying things are looking pretty good. This gap is what is going to be difficult for the Fed to decipher. Victoria joins us right now. Victoria, first question then. Are you loving this rally or hating it?
Well, I'm not loving it. I don't want to say I hate it because I think you can be opportunistic in this rally. You can trim some names that have done really well, take a little bit of money off the table and put it off to the side and wait for an opportunity to do something different. So don't hate the rally, but I don't think we're in a sustainable rally at this point. I just don't think that we have cycled through the things we need to, through the earnings, through the rest of the rate hikes, through the rate hikes that we've already had and their effects that are going through the economy. There's so many different elements out there that we still need to churn through before I think we can say we're in a sustainable rally, but use it to your advantage.
So how do you use this to your advantage?
Yeah, well, look, I mean, some of it is what we were just saying. So we've trimmed American Express. You know we like financials. It was one of our favorite sectors last year. We like it again this year because they have strong balance sheets, and we think that rates are going to continue to go a little bit higher from where they are here. But you have American Express that's up 12% year to date. Why not trim some of that, take some of that money off the table, put it into some other areas? Names like Lowe's, names like Aflac, we like insurance, or General Mills. I mean, you can find other areas in order to put some of that cash to work, but I don't think you want to make big bets at this point in time. There's just too much uncertainty, and we do think we're going into a recession probably around the middle of the year, so you need to be careful.
Well, let's talk about those big tech names that have rallied hard. And let's assume you're right. We go into recession pretty soon in the next couple of quarters. Victoria, how do you think those tech names perform in that recession?
Yeah, I think it's going to be quite difficult, Jonathan. I mean, obviously, we've had a little bit of a rally here, and in my opinion, it's an oversold rally, right? People are coming back in, names are at the bottom, and that's fine if you didn't have these names in your portfolio and you're trying to build a little bit of a position. But I think you have to be very cautious. These names are still in downtrends. So when you have starting to get an overbought position in a downtrend, that's a really dangerous place to be. And look, like I said, I don't think it's a sustainable rally. You want to look for new leadership once you hit the bottom of the market and you're starting to turn and have a sustainable rally. You want new leadership. These are the names that led last time, so I don't think it's where you want to look going forward. Have a little bit of exposure, but be cautious.
Victoria, let's just build on that just a little bit. Why are we so convinced there will be new leadership? I hear that from a lot of people. I've heard that a few times already this morning. Why are we so convinced we get new leadership? There are some people out there who just believe we're a couple of rate cuts away from old leadership reasserting itself and big tech absolutely flying.
Well, and I think that's the issue. A couple rate cuts away. When are we going to get rate cuts, Jonathan? I don't think we're getting them in 2023. I think the Fed is going to raise, obviously this week, they're going to raise again in March. I think they're going to hold for the rest of the year. So if you're waiting for rate cuts to give a rally to the tech names, I think you're waiting at least a year from now. So there's better places to be in the next 12, 18, maybe 24 months instead of these names. And I know everyone, I mean, it's the tradition, right, that you're going to have new leadership coming in. But there was so much brought forward during the pandemic for these names that I think you have to take a step back, say thank you for the gains that you've given me. Now we need to look other places.
Chairman Powell speaks tomorrow. Victoria, what are you expecting from him?
Yeah, so I think we'll get a 25 basis point hike. It's what's priced into the market. But I think where I differ probably from other people is I think he's going to remain somewhat hawkish in the press conference. I mean, if you look at all of the items that people are saying, this is why the Fed needs to stop. We have a stronger economy. Even though growth has gone down, it's somewhat strong. We've got consumers with demand that's there. We can have a soft landing if they just stop now. But these are the same elements that I think Powell is looking at to say we haven't gone far enough. We know the Fed wants to err on the side of higher rates. They're willing to go into a recession. They've told us this. So I think he's going to be a little more hawkish in the press conference than maybe what the market is pricing in. And I actually think there is a risk they could go 50 basis points based on the strong labor market that we're seeing, the GDP numbers, inflation numbers still being sticky. I know the ECI numbers came out today and they were a little bit lower than expected, but on an annual basis, we're still over 5% for wages and salaries on ECI growth. So I still think there could be an opportunity for 50 basis points tomorrow, but a slim one.
You think they can go 50? How do you think that would be received?
I don't think it would be received well. I think the market would be very upset with that. Like I said, there's a big gap right now between what the market expects is going to happen and I think what Powell is laying out in his plan. You can see it in the rate cut expectations. There's already at least 25 basis points worth of rate cuts priced in for either September or December of this year. I just don't think we're going to see that. I mean, Jonathan, let's look at these recession indicators that we have going right now. You have LEIs up over 7% year over year, the inverted yield curve, M2 growth. We haven't even talked about what's going on with M2. There's all sorts of elements wrapped up into M2 growth, still $4 trillion of excess there, which is why financial conditions are easing. So I think Powell could go 50. I don't think it will happen, but he could.
Let's say goes 25. And you know for the market, it's not about what he says, it's about what he does. And what he's going to say is one thing. How this market responds to it is another. And that's why we've got to make two guesses tomorrow. Victoria, you've got to guess what he's going to say. then you've got to guess how the market's going to respond to it. Now, let's say he says that the easing of financial conditions over the last few months is unwarranted. Do you think the market's actually going to respond to that in a material way, Victoria? Because over the last couple of months, they've all been on the same page. They've all been saying the same thing. They're saying what you're saying, which is no cuts this year, and yet still we're priced for cuts. Why does that change with the words of Chairman Powell tomorrow?
I'm not sure it changes with his words, because the market, I think, is actually looking through some of what Powell is saying. They're already looking towards the end of the year and into next year, where they think it's all going to end up in the same place. The timing may be a little different, but the end game they think will probably be the same, which is somewhere around a 5% terminal rate. So I think really the market reaction tomorrow would be if we got 50 instead of 25. You might have a little bit of movement from the press conference if Powell is extremely hawkish, but if he sticks to his story, I think the market says, yeah, we've heard this before. We're going to continue with what we think is going to happen, with the assumption that the Fed is going to match the market instead of the other way around.
Victoria, this was great, as always. Victoria Fernandez there of Crossmark. About 13 minutes into this, equities at the moment positive 1/3% on the NASDAQ, up 0.6%. Coming up, GM delivering a stronger than expected outlook.
Our engineering and manufacturing teams partnered with our supply chain teams, did a great job of increasing production last year by 25% over 2021.
That's next, plus the EV pricing war heating up. Ford following Tesla with price cuts. That conversation just around the corner.
So now you've been at JP Morgan for about 25 years?
Yes.
Okay, so, and now you run one of the most important parts of JP Morgan, which is, I say, is the asset and wealth management business. What actually is wealth management, and how is that different than asset management?
Great question. The two are often used interchangeably, but they have distinctions. The asset management business is where we manage money on behalf of individuals, institutions, sovereign wealth funds, pension funds. We manage them in mutual funds, we manage them in ETFs, we manage them in single stocks, single bonds, hedge funds, private equity, and the like. And that is the heart of the fiduciary business that we run here at JP Morgan. Wealth management is that plus understanding someone's entire balance sheet. So for the individuals where we manage money, we also help them with their mortgage. We help them with a loan that they might need. We help them with their basic credit card. And so wealth management is trying to help someone with their entire life, both their assets and their liabilities, their planning, their gifting, the legacy that they want to leave for their families, the 529 plans they need to prepare to get their kids to go through college. And it's a great insight into people's, entire journey.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The quality of our launch launches and the new vehicles that we've brought to market are really being received well by our consumers. Our engineering and manufacturing teams, partnered with our supply chain teams, did a great job of increasing production last year by 25% over 2021. And we've been seeing vehicles move very, very quickly once we get them to dealers.
GM reporting better than expected results. The CEO, Mary Barra, giving an upbeat forecast, writing the following: "We expect our momentum to help us deliver strong results once again in 23." Kaylee, back on a story. Hey, Kaylee.
Yeah, that 2023 guidance much stronger than expected. They expect profit between $6 and $7 a share. Even at the low end, that tops the average analyst estimate at $5.70. So a really healthy beat there. What's driving that is healthy volumes. Sales volumes were up 41% in the fourth quarter from the levels a year ago, and they expect that volume to be up 5 to 10% this year as well. That's helped by the fact that supply chain constraints are easing, so they're able to increase production, and increasing production of electric vehicles in particular. Mary Barra saying 2023 will be a breakout year for their Ultium platform, and that they're on track to produce 400,000 EVs in North America from 2022 through the first half of next year. So put it all together, and the market really likes this. GM up 8%, lifting peers higher as well, just continuing the outperformance we have seen from autos this year. But we know the autos narrative has changed in recent days, John, amid buzzing about a price war. We got some interesting comments coming out of the analyst call in relation to that. Mary Barra saying that the models are priced where they need to be, and the CFO, Paul Jacobson, saying he may see more discounts on models increasing this year, but he went on to say they are not preparing for a price war, John.
No cuts just yet, no big cuts anyway from them. Stock's up by more than 8%. Katie, thank you. Katie, talking about that EV price war heating up in a big way. Ford slashing prices on its electric Mustang in response to Tesla's recent discounts. RBC expecting more cuts on the way, seeing a cascading effect across the industry. Bloomberg's David Welsh joins us now in Detroit for more. David, can you run me through what you think about what we've heard so far from Ford, from Tesla, and what you're expecting next?
So if you look at the price cuts that Ford and Tesla made, they are big. It does tell you that there's serious competition now in the electric vehicle market. But in a way, a lot of what they did was scale back price increases that they had put in last year when everything in the market was scarce, including internal combustion vehicles, and everybody was fighting to find chips to build EVs, gasoline-powered vehicles, everything. So now that demand's a little softer, now that you've got more competition than just Tesla in the EV market, and Tesla has a lot of production coming online, by the way, you're seeing this pullback in pricing. Very interesting that GM doesn't think they're going to have to do that. And here's where I think they're going with this. First half, they're going to be slowly ramping up all of these Ultium-based vehicles, like the Hummer SUV and the Hummer pickup truck, the Cadillac Lyriq, and then eventually you have 2 Chevy SUVs that will compete directly with the Mustang Mach-E and with Tesla models, and you'll have the Chevy Silverado pickup. But the real production boost for General Motors will be in the second half. So they probably don't need to discount anything right now because they don't have that much production to sell. It's not like there are a bunch of General Motors made electric vehicles sitting on dealer lots that need a discount to move. So in the near term, they're probably right. Second half is where I think you'll see the true test of whether or not GM has to discount, because you'll see these vehicles that compete directly with the Mustang Mach-E, like the Chevy Blazer, like the Chevy Equinox. They also compete with Tesla Model Y and Tesla Model 3 in terms of price range. And that's when I think you'll see the pressure with these new vehicles coming out, and then we'll know whether GM is able to hold price there or not.
Hey, David, very well framed. David Welsh there out of Detroit. GM up by more than 8% right now. Got some breaking news for you in the last couple of minutes, just on some economic data. Here's Mike McKee.
Tying it in well, John, because the Chicago PMI is generally related to how the auto industry is doing. A lot of manufacturing plants there, and it's down slightly, 44.3 from 44.9. It was forecast to go up just a little bit, so they're still struggling with some contraction in the Chicago manufacturing area. Tomorrow, the ISM manufacturing comes out. That's going to be the interesting one that everybody wants to watch. The regionals have all been mixed, half up, half down. So no good call on that yet.
Put it all together, Mike. 25 just now done. We heard maybe 15 minutes ago Victoria talking about the potential for 50. How surprised would you be by a 50 basis point hike tomorrow?
Less surprised than I would have at some changes in other meetings, but I think they've left the impression they're going to do 25 at the markets, and there's no real reason to surprise the markets now.
Mike, looking forward to your coverage, as always. About 22 minutes into the session here, we advance a third of 1% on the S&P, and the Nasdaq up a half of 1%, with some sector price action. Here's Abby.
Hey, John. Well, we do have most sectors higher with that small gain for the S&P 500, and consumer discretionary really outperforming on that GM quarter. UPS also putting up a good quarter. So both of those shares higher. GM up by about 8% as we saw, UPS by about 3%. So that is the sector that's leading. The materials, communication services. On bottom, energy, utilities, and financials. And it's interesting, we are, of course, in earnings season, as you know. And relative to the sectors that hold on to post-number gains, well, it's discretionary. And this number so far up 3.7%. It's likely to go higher after today with GM and UPS. We also have materials, communications, and financials in there. The industrials also holding on. We'll have to get tech in there and see what's going on for that tech sector, whether or not those stocks hold on to the gains.
Abby, thank you. Looking forward to Snap a little bit later. Your trading diary up next.
Seeds, typically between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
This is Bloomberg.
Following the biggest one-day loss of the year so far in 23 on the Nasdaq, we try and bounce back by 0.6%. On the S&P, up by about 0.4%. That's the price action. Let's get you the trading diary. President Biden in New York discussing infrastructure at 12:30 Eastern. A Fed rate decision, Chairman Powell news conference on Wednesday, followed by earnings from Meta. Rate decisions from the ECB and BOE coming on Thursday, plus results from Apple, Google, Amazon, all coming up. And finally, jobs day in America to round out the week on Friday. Special coverage of the Fed tomorrow on this show. Fantastic lineup for you. For the 9 o'clock hour, we have Kathy Jones, Bob Michael, Chris Harvey, and Mike Wilson, all coming up tomorrow, 9 o'clock Eastern Time. Do not miss that. Looking forward to covering all those stories with you. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Why is it that whenever there is like a scare coming along or a pandemic or something, people rush to buy toilet paper? You ever notice that? People are they're stockpiling toilet paper.
It's
Is that
called hoarding, and
okay.
it's one of those things you never want to be without.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands.